Okay, guys, I think we'll start now. This live is going to be recorded. It's recording right now as we speak. So, people who need to come back and watch this live again, or for people who haven't attended the live, will be able to go ahead and view it once it's uploaded. Okay, so we'll go into it. Does everybody understand supply and demand already? Just so I know where you guys are at. Jean says yes. Ben says not very well. Okay. You should do after this. I've decided to structure this lesson more of a way where we go into the actual mechanics of why supply and demand is printed and what it actually means. And obviously later on in the live stream, we will then go into the theory of it and the actual real life charts as well, because I appreciate not all of you learn very well when it's, drawings and stuff. So, okay. So we'll go into it. So the first question we got to ask, Ismail says, yes, I do. I'm struggling with price action. Most of my eyes can't see swing highs and lows. Okay, so with the swing highs and lows, we did go through that in the last two live streams. I can post the link to my YouTube channel where both live streams were uploaded. And after this, you can go ahead and view that. They're both over 1 hour long videos where you can go ahead and do your studying on highs and lows there. I've just posted the link into the YouTube into the chat box for you. No problem. Okay, so we'll go ahead with market mechanics. So this is obviously the meanings behind supply and demand and why they are printed. Ben says, so today I also get a little confused in finding the overall bias. Okay, yeah, so definitely market structure. The very first YouTube video I posted, that will definitely help you to find your overall bias of market structure. So after this, definitely go and watch that. I do believe it will really help you. It's about an hour and a half long video, and we do go really in depth of market structure and how to understand that as a whole. Okay, so we'll go into it. Market mechanics. So the first question we need to ask ourselves is, how does the market move? Okay, so how does it move? Why does it move? So we have the big companies. Okay, so that would be your banks, your large financial institutions, and whatever. And let's say a large company needs to buy a large amount of metal from the United States. They would then need to go to the bank and exchange their currency for dollars. Okay, so this will strengthen one currency over another. And transactions like this will move the markets. And there are other factors, of course, which move the markets, but the example I just gave is obviously one that happens daily, day in and day out. These transactions then reflect onto the charts that we analyze, such as GBP USD, Euro USD, and whatnot. And us being speculators, we then try to make a profit from those moves. And that also includes the large financial institutions, etc. Obviously, they see these moves and they want to participate and make a profit from those moves also. So all of what I just mentioned is then affected by human emotion. And this is what drives the order flow in the market. So the interaction between both buyers and sellers prints the price action on the charts, and this is the very same price action that creates the patterns that we see repeat themselves daily on the charts, day in and day out. And by understanding this, we can then start to see where price may be potentially moving in the near future. Okay. So every day, both retail, commercial, institutional traders, whatever, they all buy and sell currencies, and they all do so with their own unique reasons. Okay. And the point between both buyers and sellers is what we call obviously the current price. So you know when you're looking on your charts and you look on TradingView at the far right, you'll have a red box or a black box, whatever your colors are, highlighting a number. This is your current price. Okay. So no trades can take place, sorry, unless both buyers and sellers actually agree on a price. And this demand pushes a currency pair, obviously due to the demand, it pushes it up. And while the sellers, they drag the price down due to supply. Okay. So this is where we're going to go through some drawings. And again, any questions you guys may have, please stop me and we will go through it in depth. So when price is at its highest, okay, demand or quantity in this case will be at its lowest. We've got a chat box. Angelo says, "What's up? What's up, man? How are you, Angelo? You okay? Good to see you here, man. Good to see you here." Okay, so we'll call this. So we'll call this one P1. So obviously this is price one, and then we'll call this Q1, which is obviously quantity one. So at P1 and Q1, the price is at its highest while quantity is at its lowest. So not many people will want to or can buy here. So obviously where quantity is at its lowest, that's where the price is at its highest, because the demand is not really there. So the price for it is really, really high. Okay. So then now we need to come to P2, which is obviously the price mark 2. And then we'll have Q2 representing quantity 2. Let's mark this out. And I appreciate guys looking at this. It doesn't look like the charts, and maybe you're thinking, what the hell is he talking about? But trust me, this is all going to make a lot more sense once we start to talk about the institutional supply and demand. Okay, so please just bear with me and trust me, you'll understand why we are drawing these things, which look like they have nothing to do with Forex, but trust me, it all ties in together. So we'll go through this again. So P1 and Q1. So this is where the price is at its highest while the quantity is at its lowest. Okay. And then we've got P2, the price mark 2 and quantity mark 2. And as price falls, the demand will increase for this specific currency. So many people will want to buy here because as price falls, demand increases also. Okay, so, you can see this day in and day out with other things. So let's say you go to a shop. I don't know what store you have in your country. So we've have Tesco here in the UK, and we've got Walmart over in the USA. So when there is a price reduction on things, people are rushing into the store to buy those things because why? Because they are cheaper, no? So that's obviously common knowledge. Okay, so this is the demand scale. Okay, so we'll just call this one demand. Okay, so I'll go through that one more time, just one more time for you guys who are taking notes and maybe I'm speaking too fast. So obviously we've got this chart here. So this axis is the price axis and this axis is the quantity axis. Okay. So we've got price one and quantity one, obviously the price of the product and the quantity of the product, or in this case, currency. And when the price P1 is at its highest, not many people will want to buy it. Therefore, the demand for it is low. Okay, so price is high, quantity is low, or demand is low. But when price falls, the demand for this product, or in this case, currency, heightens. It gets higher. We have more people that are willing or able to buy this at this current price. Okay, so that's demand. Now we'll go to the supply chart. Okay, yeah. So we've got the price here, and then we've got the quantity here, and this line going this way obviously is showing the demand, and then obviously this price going here is showing the supply. So let's say we've got this line coming here and this line coming here. Okay, so so yeah, we'll go through that one more time. So at P1 and Q1, price is at its lowest and quantity is also at its lowest. But at P2 and Q2, price is at its highest. So supply of the quantity is also at its highest. This is because the sellers will want to sell more while the price is still high. Does that make sense? And again, I appreciate this. This looks like it has nothing to do with Forex, but trust me, you will see in a moment why we are drawing this out. Kim says, so buy low and sell high. Yeah, so essentially what I'm saying here, this is not obviously me telling you buy low, sell high. Everyone knows that type of thing, but it's me just showing you the actual force behind why demand and supply is such. Okay, so obviously here with P1 and Q1, price is obviously at its lowest. And then with P2 and Q2, price and the quantity is at its highest. So the suppliers, the sellers who are selling this specific product, or in our case, currency, will want to sell it while price is at its highest. Okay, does that make sense, guys? Yep. Okay. So knowing this, we can't just view one alone. We can't have one without the other. Okay. So obviously we've got the demand and we've got the supply, meaning we've got the buyers and we've got the sellers, but we can't just have one within the market. We need both. Okay. Because the buyers and the sellers are what make a market a market. Okay. So again, we can't just have the demand, we can't just have the supply. We need both. So let's just draw one more chart. Promise you guys, this is the last part of the boring drawings. Okay, so this is where it all starts to make sense why I'm drawing all of this. Okay, so where price is now meeting here, this is what we call current price action, or current price. Sorry, just centralize this. Okay, so where demand and supply meet, which is obviously at this cross section here, this is where we obviously have current price. Okay, so this is where both buyers and sellers both agree on a price. But what happens when there is too much demand but no supply? Obviously, the price will increase to give suppliers a reason to sell. So this is where the demand moves higher. Okay, so obviously we've got here, this was the fair market price, okay? But now because demand has increased and there is no supply, what happens? Price increases also, because if there is no supply, but there's a lot of demand of this specific currency or product, whatever you want to view it as, the price will always increase, okay? So we can mark this out here. And we'll mark this one also. So now this is our new current market price, okay? Because this is where both buyers and sellers are now agreeing to trade, okay? Because once before it was here when the demand and supply met, but now there is too much demand and not enough supply, the price then increases. So P2 here. So yes, once before the demand and supply met here, okay? So the price of the specific currency was here and the supply of it was here. So this is where both buyers and sellers agreed on a price, but when there is too much demand and not enough supply, obviously the price will increase. Therefore, also the quantity of the product will increase. Okay, that's why we've drawn these two as a single, so you can just understand each thing on its own. Now, this is where they both come together. Okay, so just one more time, we'll go through that again for people who may be taking notes. when demand and supply meet at a specific point, in this case, it's right here. This is where current price is, okay? So when you look at your charts, I'm sure you guys can see the axes here. This is current price right here on Euro USD. We've got 1.05620. So at this price right here, this is where demand and supply meet. Okay, this is the fair market price for buyers and sellers to both get in and be able to trade that specific currency pair. Okay, so that's what I'm talking about when we go through this. But when there is too much demand and not enough supply, there is now a new fair market price where both buyers and sellers will agree to trade at. Okay, does that make sense, everyone? Cool. So we can delete these two now because I'm sure you guys actually no, we'll leave it there for people who may be still drawing this on. Okay, so at this point where there is too much demand and not enough supply, or vice versa, too much supply and not enough demand, this is where the large institutions will have the ability to quote unquote control, if you will, the price of the market and potentially have you enter in on the wrong side of the market. But when you can recognize these areas that this happens in, it will actually give you a chance to actually join in on them with them on their moves. And we will cover this later on because they do actually leave behind clues in price action when these aggressive shifts are actually going to happen. We've got some chats here. Will this be recorded and uploaded today? Yes, it will. It might not be uploaded today because I do think this is going to be the longest stream we've had so far. So we've had two streams and the longest one was about 2.5 hours. I do believe this one might be a bit longer. So yeah, no problem if you guys got other things to do, you can leave and I will I'll upload this onto YouTube so you guys can actually go ahead and watch this in your free time. Okay, so no problem there. So we'll go over this just one more time. So obviously, where there is too much demand and not enough supply, or too much supply and not enough demand, this is where the large institutions will actually have the ability to control, if you will, the price of the market and potentially have you enter in on the wrong side of the market. And when you can recognize these areas that these things will happen in, it will give you a chance to join in on these big moves. Okay. So, and as I said, we will cover this later on, so don't worry. But before we actually go into this, let's go through order flow. Okay. Does everyone know and understand order flow? I'm sure many of you guys have heard the phrase order flow before, but do you know what it actually is? Who says kinda? Okay, so order flow is essentially the interaction between buyers and sellers. It would be nice to have a small recap for order flow from you. Yeah. So essentially, order flow is the interaction between buyers and sellers. Okay. So we have passive orders, which are essentially limit orders and stop orders. So obviously, you've got your buy limit, sell limit, buy stop, and sell stop. Okay. I'm sure all of you are familiar with those. And then we have aggressive orders, which actually most of us execute within the live markets. And this is where you want to enter in at the market straight away at the current price. And this is essentially, as a whole, order flow. Okay. You can then see what this looks like by viewing the DOM. And I'm not sure if you guys know what the DOM is, but it's short of the depth of market. And this tool will be able to show you, obviously, on that broker, all the current orders in the market and in the order book, whether at bid price, ask price, passive orders, or aggressive orders. Okay, so the DOM is actually a very, very useful tool if you know how to read it. Okay, we might go through this today. If we don't get enough time to, I really recommend you guys go ahead and watch some other videos regarding the depth of the market. It's very, very interesting. Okay. So let's say we have a company in the USA and they want to transact 10,000 lots of the dollar into the euro. Okay. They would then have to call the bank and request this transaction. And then the bank would then go to the markets to facilitate this exchange. How? How would they do that? So they would put those 10,000 through the euro to dollar market, because obviously in this case we've got the American company that wants to exchange their dollar for the euro. Okay, so they would go to the euro USD market and exchange the dollar for the euro, but they wouldn't put this whole 10,000 lots in at one time, okay, because then there would be a huge amount of slippage and they wouldn't actually be able to exchange this 10,000 lots of the dollar for the euro at the best price for their client. Okay, so obviously the banks, they are largely incentivized to be able to have these strategies at hand to be able to exchange whatever price, whatever currency for whatever other currency at the best price. Okay, so what they might actually do is put half. So let's say they put 5,000 lots into the market, and then they would wait for price to return to the same price with a buy limit and exchange the remaining dollars, so the remaining 5,000 lots, for euro. So many of you guys might actually know what I'm talking about, but let's see what that looks like. And I'm sure when I draw it on here, you guys are going to actually have it click in your head why we drew all of this and why we've been talking about everything that doesn't really seem to link in with Forex. Okay, so let's draw this on and you'll understand. I'm sure you will. Okay, so let's just go through that one more time. So let's say we've got an American company that want to exchange 10,000 lots worth of American dollars for euros. They would then call the bank. The bank would then go to the markets to facilitate this transaction, but they're not going to put the whole 10,000 lots in at once. Why? Because there would be a huge amount of slippage and they wouldn't be able to actually exchange this money at the best price for their clients. Okay, otherwise the clients will just go and find another bank that will do it at a better price and stick with them. Okay, so obviously the banks, they want to keep their clients so they can make a profit off of them too. Okay, so anyway, how would this look like on the markets? So let's say we've got price ranging. Okay, and then at this point here, let's say this at current price here, the bank in America calls their bank that they do business with and say, we want to transact 10,000 lots of the dollar for euro. Okay, so let's say this is the current price. What would price do? Price would then shoot up and break out of this range. Okay, so this is the first 5,000 lots. Okay, do you think that now, obviously, price being at a premium, this is a question to you guys. Do you think price now being at the premium, they would then continue to put the other 5,000 lots and have price drive higher? Do you think they would do that? And I want you to explain your answer too. So if it's yes, tell me why. If it's no, tell me why you believe that. Okay, you don't understand the question. Okay, so I'll just go through that one more time. Okay, so let's say price is now ranging. Okay. And then at this point, this low, this is let's say we don't see this shoot up yet. This low here is where current price action is. Then at this moment where price is, the company in America now call the bank that they do business with, and they say, we want to transact 10,000 lots worth of the dollar into the euro. Please give us the best price. Okay. So at this point, the banks, they inject 5,000 worth of lots into the market, and obviously that shoots the market up. Okay. Do you think now at this specific moment where price is now at a premium, and what premium means is now price is expensive, do you think they would then continue to put the other 5,000 lots while price is here and obviously shoot the market up higher? Deep says no. Gene says no, they want the lowest average. Kim says no, bring price to where they open and then go back and then go up to closing profit. No, price needs to go to discounted zones. No, they need another lot size to take the remaining orders. Okay, so Ismail has hit the nail on the head. Okay, he says price needs to get back to discounted zones. Why? Why does price need to go back to discounted zones? And I'll answer that. They wouldn't put the remaining 5,000 lots here because price is at a premium. Price is now expensive. So they would wait for price to get back into discounted zones and then buy again. I'm sure all of you now understand why we have been going through this. What does this look like here to you? Gene says a breakout and retest. Yep. There's a hint in the name of the live stream. What is this? Demand. Yes, demand. The price, obviously, this is where demand overpowered supply. Okay, so the demand, which obviously the demand has come from the American company, they demanded that their 10,000 lots worth of the American dollar be changed into euro. So this is where half of it, the 5,000 lots were injected into the market. So demand overpowered supply, and we had shot up. Okay, this is where now supply had kicked in, okay, because obviously the more demand there is, the supply also kicks into. Okay, so when many people want something, there's a high demand for it, so a company has to supply that. Okay, so this is where supply kicks in. We've come back to the discounted areas, back to this whole demand zone. And this is where the bank would inject the rest of the 5,000 lots to then have it at a better price, okay, for their client to be able to shoot it back up and exchange those that remaining 5,000 lots into euros. Okay, does that make sense, guys? Good. So this should be a pattern that you guys recognize, okay? And this is how we can start to have clues of high probable setups. Okay, so this in a nutshell is how supply and demand works. Okay, so we've got again here, we'll just go through it one more time. Demand overpowered supply. Okay, we've shot up and we've come down back into the demand, obviously because supply stepped in here because there was a high demand for the price. It came back down into our demand zone, and now the bank were able to facilitate or finish that transaction because it has now returned to a cheaper price, a discounted price, and then inject the remaining 5,000 to facilitate their transaction for their client. And they have now successfully exchanged 10,000 lots worth of the American dollar to euros for their client at the best price. Okay. So we'll just go for a quick summary of this because we've got 2 minutes left on the live stream, and then I'll close the live stream and I'll send a link straight away for the new one, okay? The second one. So a summary, we are looking for large imbalances between supply and demand. Okay, so we've got supply and demand here. Obviously, we're ranging. Then we're looking for that large imbalance. This is where the banks have showed the first hand. They've showed us the first clue of what they are looking to do, which is where we've broken out. Demand has overpowered supply. Now look, supply has stepped in. We've come back into that demand zone. This is where we step in at this specific point here, because this is the most high probable trade. We have now coming into demand and we are looking to get long and aim for this weak high. Okay, and again, strong highs, strong lows, weak highs and weak lows. We've gone through that in the last live streams, but I'll ask it again. Why is this a weak high, guys? Why is this weak? Failed to make a lower low. Perfect. Kim has hit the nail on the head. Deep says not made a low low. iPhone says it failed to take the strong low. Perfect. That is why this is now a weak high, okay? And obviously when price aggressively shoots up, we want to buy when price returns to the demand area. And when price aggressively shoots down, we want to wait for price to return to our supply area to then head back down. Okay, guys, we've got about 30 seconds left on this live stream. So I'm going to end this and send a new link right away. I'll see you there. But yeah, essentially we've gone through all of the important stuff now, with the theory. Hi Sip, what's going on, man? So yeah, we've gone through all the most important things, in the theory, and we are now gonna go into the live charts and see where these S&D zones, supply and demand zones, actually like what they look like. Okay. I'm sure all of you know, but with all of this thing that we've gone through here, I hope that you will actually start to understand the mechanics behind it and why the price, or why the market rather, does like why it does react at these certain points. Okay, so obviously just to cover it again really quickly, we've got obviously the demand line here. When price is high, the demand for it is low because not a lot of people actually want to buy at that high price. But then when the price is low, the demand for it becomes high, obviously, because more people are able or are willing to actually enter in at that price and buy it. Okay, then we've got the supply. When the price is high, the quantity of the supply is high because obviously the suppliers are more incentivized to actually sell at this high price. And when the price is low, the quantity of supply is low because the suppliers don't actually want to continue selling at this low price, or rather they would sell all their current supply at this price to then get more once price is now starting to go higher. Obviously, they would then buy at the lower price to then wait to start releasing their supply at a higher price. And then obviously, again, when the two come together and they are combined, when demand meets supply and price is somewhat in the middle and quantity is somewhat in the middle at the equilibrium, this is where the meeting point is. So this exact meeting point here is where current price is. But then when demand is then increased but supply is not matching it, the price then increases, and then that will in turn increase the quantity because the suppliers will then want to facilitate the product to then be able to sorry, I can't even speak English, to facilitate the sales of at that price, the higher price. Okay. Hope that makes sense for you guys. And then obviously that's how it looks like in the market. So obviously we've got the range, then we get the initiation out of the range. Obviously, this is where the 10,000 lots example we went through. Obviously, the first 5,000 was injected here, so we broke out of that range. Obviously, demand beating supply, overpowering supply. Then supply steps in because the demand is high. Okay, so people start selling, the suppliers start selling, and we come down back into our demand zone, and then we flip back up to facilitate the rest of the order of this quote unquote American company that wanted to transact 10,000 lots of American dollar into the euro. Okay, so I really, really hope all of you guys understood that. Please comment in the chat box if we need to go through that again before we carry on. Not always, Kim. No, not always, because if you think about it, when we look at the live markets, it won't always be something that looks like this, then breaks out, comes back in. Sometimes you'll have what we call pivot zones, which we will cover again today. We will cover everything today. I do believe this is going to be quite a long live stream. But yeah, we will cover that later on. Essentially what a pivot zone is where let's just get out my tool. So let's say price is already coming down. Okay, then we get this small pause in price and then price comes back down. This is now a pivot zone, but it's still valid supply. Okay, price could still come back into here to grab all those resting orders and then continue to the downside. Okay, so it doesn't always have to consolidate as such like this. I mean, I guess you could call this consolidation because on a lower time frame, this, would be going from side to side. But obviously, if we're looking at the higher time frame, it wouldn't look as such. But again, yeah, to answer your question in a more simple way, not necessarily. It doesn't have to be a long extended period of ranging. It could just be a pivot zone where we're already heading to the downside. It's not so much where we're just going side to side. We could already be heading to the downside. We get that small pause in price action, then price shoots back down, and obviously the price will then head its way back up to grab the remaining orders and then head back to the downside. Yes, so when we're looking at supply and demand, we always want to be looking for those impulsive movements. And another way you could actually, if you're writing this down, guys, another way you could have it as mechanical as possible is when you're looking at supply and demand, you always want your demand or supply zone to be close to fair value gaps. Okay, so obviously we know with fair value gaps, what does that mean? It means there's a huge imbalance, a huge overpowerment of supply rather than demand, or a huge empowerment over demand rather than supply. Okay, so we're looking at those huge fair value gaps. If you guys know what fair value gaps are, we're looking for those, and that essentially confirms that that is a valid supply zone. And obviously a lot more things, a lot more other factors that we will cover later on, which will help you understand what a valid supply zone looks like, such as obviously it not being mitigated already, and so on and so on. We will cover all of this today. Is everyone happy if we move on to the theory of supply and demand creation? No problem. Is everyone happy? Yeah, okay. So let's look at hi, just joined now. Have you already gone through GU? This live stream isn't for analysis as such yet. We're going through supply and demand. But if you would like, I can go through GU at the end of the live stream. Okay, so let's go through a range so we can fully understand what a range is and the components of a range. Okay, so this is what a range looks like, where it doesn't have a clear direction to the upside or the downside. So up here, this is what we would call a premium, and down here, apologies, this is what we would call our discount. Okay, so our premium is essentially where price is expensive, and our discount obviously is where price is cheap. And then in between that, we have what is called our equilibrium. Okay, that's where price is neither expensive nor cheap. It's a fair price for the current pair that you are looking at. Okay, let's just even this up. Okay. So once we get a huge breakout of this zone, it suggests that there has been a large order put through the markets. Okay, so what that looks like is this. So once we get a breakout, that suggests again that there has been a large order put through the market. So just to make this easier to understand, we could again use the same analogy we went through with the quote unquote large corporation in America that wants to transact 10,000 worth of lots of the American dollar to the euro. Okay, so this phase is what we would call the initiation phase. Okay, and the reason we call it the initiation phase is because this is where price has now initiated the up movement, where obviously this is our first clue to what price is now going to do. So just for the sake of drawing this on, we're going to extend this out a bit actually. Okay, so again, premium, discount, equilibrium. This is the initiation phase. Okay, so this is where the big banks have initiated the first clue to us of what they are looking to do. Okay, so they've dealt their first hand. So now this is the mitigation phase. Okay, so this is where price has now come up, supply has now stepped in, and we are now heading back into our mitigation zone. And what mitigation means is where essentially we are mitigating, quote unquote, tapping in back to our demand zone, ready to look for buy entries to come back up, obviously in a bullish context. Okay, so once we get the initiation, which is essentially our first clue that the financial institutions have put through a large order, we then wait for our mitigation. Okay, and again, the mitigation is essentially the area of demand or supply that we want to enter in at and ride the continuation. And what do I mean by continuation? So this is the continuation. Okay, and the reason I call it a continuation is because the initiation phase obviously heading up, because the big banks have now put in that first quote unquote 5,000 lots for their client to come to exchange it into euros. So that has surged price up. Okay, Then we've got that mitigation phase. So now price has come back down, obviously because of supply stepping in. And then obviously mitigation here. So let's just write this down just so everyone who is drawing this can have a fuller understanding. Okay, so we'll just go through that one more time. So once we get that initiation, which is obviously the first hand that the big banks have shown us that we are now heading up to the upside, this is essentially the first clue. Okay, this is the first clue of what they want to do, which obviously we know in this case is to come back down and head back up again. We don't want to buy here. We want to be patient. We want to enter where we can get it at the cheapest price. Okay, we don't want to enter here for then our stop loss to be all the way down here and then aim for a price which is not, we don't really have a price to enter in at. Rather, we want to get down here at the mitigation area with our stops just below the low and obviously aiming for that weak high where risk to reward is in our favor. Okay. So again, once we've got that mitigation phase, which is essentially the area of demand or supply we want to enter in at, and then we want to ride the continuation to the upside, okay? And then that's what it looks like in a bullish context, okay? Now let's see what it looks like in a bearish context. So we've got that range, then we break out of that range. So obviously, again, if we look to the left here, this is our initiation. We've got the premium we've got the premium pricing here, the discounted pricing here, obviously in the bearish market sense. We've got our equilibrium in the middle. So price is now broken out. We've showed that we the banks have shown us that supply has overpowered demand. Okay, price has now broken it, and now at this exact point, we want to be patient. We want to sit on our hands. We don't want to trade until price is now showing the mitigation phase. Okay, so price has now come back into our supply zone, and now we are heading back to the downside. Once price has come back into our supply zone, picked up all the orders, and we are now again heading to the downside. Is everyone happy with that so far? And obviously, guys, you guys can you can go back and watch the previous streams we did on the three musketeers of structure, and that will show you when we can predict that this whole movement here, this sharp turn, that's when you can predict when to get in, because obviously that's not all the time there's going to be a clear demand zone here, so you can use that live stream to learn when to get in. And obviously later on in this live stream we'll cover what to do if there isn't a clear demand zone here, because obviously some people like to see a candle in the opposite direction. So obviously here we would be having these bullish candles coming all the way here, but some people only like to enter in on the most extreme demand zone, which would obviously be a sell candle before we get that push up. So we'll look into all of that later on today. Okay, so let's just delete all of this and we'll move on to the real life markets. Okay, so now let's head into the real life markets, and please stop me if there's at any moment in time you need to um, get a fuller understanding or need to ask any questions. Okay, so this is a very, very good example here. Okay, so we've got a range right here. Okay, price doesn't really have a clear direction. We've pulled down, and then this is where we get a sharp injection to the upside. Okay, we get a sharp movement to the upside. That is the very first hand the banks have shown us that we are now ready to use this framework that I'm showing you to get in long to the upside. Okay, so we've come up a large injection of lot size to the upside. Okay, we're coming all the way up, and then this is where this is where supply steps in. Okay, because there's too much demand now, or let's say a lot of demand for this current pair. So this is where supply steps in. So we come back down. Okay, and then this is where the mitigation phase happens. Okay, so we'll just draw this out the same way we drew it there. So we've got this box indicating our range. Okay. Then we get the initiation phase right here. Okay, so this whole push up here is our initiation phase. And I guess you could also say that um this area of our demand was actually tapped into because this whole range here is actually our demand range. Okay, some people don't look at it that way, but I do, and I will explain why soon. But this whole box here for me is our demand range. Why is it our demand range? Because this is the place where price wasn't actually going anywhere until whatever uh corporation or institution in America called up their banks and said, we want to transact our dollars for the euro. So this is where price now surged, and obviously supply stepped in. Coming down, this is mitigation phase. This is where we again mitigate our demand zone deeper. So obviously, some resting orders would have got filled here, but not all of them. As you can see, we didn't even pull in past our equilibrium. So we can come and mark it here just so I can show you guys what that looks like. This 50% mark would have been our equilibrium. Okay. That would have been the halfway mark between all of this. And then this is where price now comes in and taps just below our equilibrium into what is now known as, or now known to us, a cheap price to buy into. Okay, so now after that mitigation phase, we get the continuation phase where we can actually start to look for those longs to the upside. Okay, and this is exactly how I analyze my charts day in and day out, and I look for these high probable movements. Okay, so after seeing this range and price has now broken out of that range, I would then again mark out my range zone, wait for price to enter back in for that mitigation phase, whether it be a refined demand zone within here. We will go through how I do that later on. Enter in on a long, and again, our take profit would have got smashed. It wouldn't have gone anywhere near our stop loss because I would have had to position looking something like this if it was a long-term position. So again, let's say we entered in right there with a sniper entry. Our stop loss would have been at the low of that range, aiming for the week high. Okay, and again, this is a week high. Why? Because it pulls back but fails to break below our strong low. Okay, so that would be essentially what the trade would have looked like, assuming that we got in at this sniper entry. Again, that doesn't happen all the time, but yeah, that's what the trade would have looked like. Is everyone happy with that so far? Yeah, cool. So let's just go back into some theory of S&D zones, supply and demand zones. So obviously we now know the range, what ranges look like. Let's just draw this one again, people who may be doing the same. So we get that range, then we break out of that range, showing that supply has now overpowered demand. We break out, very, very big push to the downside. This is where we look for a mitigation phase. We want price to now return to us, to a price where we are happy to sell at, and now head back to the downside, aiming obviously for this week low. Okay, that's in a bearish context. And now in a bullish context, again, I appreciate this is very, very repetitive, but just so the people who may not understand yet can understand, we get that push up, breaking out of our range, obviously showing that there has been a big hand played. We wait for that mitigation phase to come back into our demand zone and look to carry on to the upside like that. Okay, so that is obviously our range zone supply and demand, and you guys should be very, very familiar with that because that plays in and day out. And this is obviously the pivot zones now. Okay, so pivot zones again is where price is already heading to the downside, and then we'll get that small pause in price, and then we'll get a large push down, larger than all the other movements to the downside. Okay, so this is obviously again where price is now showing us, or rather the banks are showing us their footprint or their clues of what is about to happen. So after we get that pause where price is obviously going nowhere, it doesn't have a clear direction, then we get that big push down showing that a large transaction is taking place. We wait for price to come back up into our zone and then head on back to the downside. But this is where things get a bit sticky because price, let's say we have a refined zone, which is right here. Okay. Price just misses it. Okay. you'd be kicking yourself thinking, oh, why, like, how come it missed my zone? That would have been such a nice trade. It would have hit final take profit. That happens every single day to a lot of traders. But this is the thing that you have to have in the back of your mind, okay? This whole area is valid supply. Okay, this whole area is valid. That's why when you're refining your zones, and we will go through how to correctly refine zones to the point where you're not refining it too much where you miss out. Okay. So when you're refining zones, you need to have in the back of your head that this whole pause area here, quote unquote, as Kim said earlier, consolidation phase, this is where you want to have the back in your mind that this all is valid supply, okay? And we'll, as I said before, we will go through later on today how to um, find refined zones within all of this to make sure it's not too small to where something like this could happen, okay? And then the same story in a bullish scenario, okay? So we come find our tool. Where is it? Here it is. So we could have pushes to the upside, okay? Then we'll get a slight pause, and then we'll get a huge push up bigger than the rest. Okay, this again is the first clue that the banks have shown their hand of what they want to do. The big transaction has happened. Now we wait for price to come back into this into our demand zone and wait for, and obviously we want to wait for this because the banks are not going to continuously push up. Why? Because they want to enter in at a cheap price. Okay, they want to enter in at a cheaper price than they did or the same price that they did here to get the best price for their client. Okay. And then obviously we're looking to head all the way back up. So that is essentially pivot zones. Okay. So pivot zones are when price is moving in one direction and we'll get a pause, then a large push in the same direction. And obviously we're waiting for the that is the initiation and waiting for the pullback, which is again mitigation, and we want to look for the continuation where we will obviously be looking to get in short in a bearish situation and looking to get in long at a bullish situation. Okay. And one thing I do want to mention, I don't really trade these pivot S&D zones as much as I do the range S&D zones, just because I don't actually find them to be that high probable. Because again, price could just do this. Let's say we've got a bearish pivot zone. Price is now doing this. We come down, we show this, and then we come all the way up to sweep all this liquidity to, or even sweep this liquidity and then come back down. And this is why I don't really like to trade this because, as I said, it's not as I have found, it's not as high probable trades as something like the range ones are because you've got a larger area of demand to work with, and you can really be picky with the area you want to get in. And if you're not entered in at the price you want to enter in, you've got a lot of room to then find a new area to enter in. Even if you enter late, when you exit the trade in profit, in my books, it's a winning trade. Okay, so yeah, I trade the range zones regarding supply and demand much more than I do trade the pivot zones regarding supply and demand. Okay, so let's see if we can find a pivot zone example on the real life charts. Okay, so if we see here, we've got price coming up, we've pulled back, come up, pull back, come up, pulled back, and then we get that big surge to the upside, much larger than all these ones. I'm pretty sure you guys can see how much bigger and how much more aggressive this surge is compared to all these pushes up. Okay, so some people would look for this candle trading in the opposite direction before we got that push up. And notice, guys, notice that we have fair value gaps in between here, showing that there is a large imbalance of demand over supply. Okay, so now we would draw our line out here and we get mitigated once here and mitigated again here. Okay, so obviously your trade would look something like this. Enter just at the edge of the box. Maybe you have your stop loss below the wicks or just below. Maybe you have a fixed pip roll off below. Let's say you're here, you see it's 30 pips, you want to add another 10 pips, no problem with that, as long as you're always using risk management. Again, you aim for the high, and look, the trade plays out. Okay, it does come up. You're probably in profit here, a lot of profit. It comes, pulls back into your entry zone. You could be panicking, but this is where your psychology comes into play. You wait your trade out, you trust your trade setup, and in this case, it works out. Okay, so that's actually a very, very clean example of pivot zone supply and demand. Okay, because you've come down, pulled up, come back down. You've got that large surge of price action coming upwards, indicating that something has happened here with the large financial institutions. Price has now come back down, pulled back into our demand zone. This is the mitigation phase, obviously, this being the initiation phase. After that mitigation phase, this is where you want to get in again for that long, aiming for this weak high. Okay, does that make sense for a bearish example of pivot zones for you guys? We can go into a bearish one if we find one, but just before we move on, did that make sense? Yeah, yeah, okay, cool. So let's see if we can find a bearish example. Yeah, this is where euro dollar was moving quite bearish. So you see here, we've got that large push down, causing that break of structure for the continuation of trend. Then we get that small pause in price action, whether you want to call that internal pullback, whatever you want to call it. We've got that small pause, okay? Then price has now largely pushed down, aggressively pushed down, showing the first hand of what the banks are want to do. Okay, so then this whole area here is valid supply. Okay, and again, we will go in how to refine these zones later on, but that whole area, just to keep it simple, is valid supply. Oh, what have I done there? Okay, again, so that whole area there is valid supply, and price does come up above it a little bit. But again, this is where you always want to have in the back of your mind that this does happen day in and day out. Price will come up and sweep liquidity above it before showing that true hand. Okay, so this is where you could again have your fixed pip rule with maybe when you enter in, you don't want to always have your stop loss at the very end of the box. So let's say in this case it's 30 pips, maybe you want to add another 10, 15, 20 pips. So let's say in this case you added another 10 pips, you would be stopped out. Let's say you added another 15 pips, you would have been stopped out. Let's say you added uh, another 5 pips, you would have been stopped out. Another 5 pips, and you wouldn't have been stopped out. Okay, but this is where you always want to have your own discretion of where you place your stop losses. We will be going through in another live stream, which is the best way to actually look at where placing your stop loss is obviously good or key in that sense. So for me, I probably would have placed my stop if I placed my stop here and I got stopped out, knowing that this is a very, very valid supply, I would have re-entered. That's me being very honest with you. I wouldn't have, bowed my head and been very pissed off with the fact that I lost. I would have been ready, rubbing my hands to get in for a re-entry. Okay. So seeing that price has now come up, Kim says, do you enter on the 4 hour? No. So essentially what I do is I'm just showing you this now because it's actually very, very clear just for people's understanding. But what I do is I would go down a time frame to the 15-minute or the 5 minute sometimes, okay? Because with the 5 minute, with the 5 and 15 minute, I'm able to get a larger risk to reward. Okay. I'm able to get a lot more money for my trade doing it that way. And if you guys want, we can cover that later on today. Or actually, we do have a scheduled live stream dedicated to that, actually, entries. The whole live stream will be named entries, and I'll be going through exactly the process I go through of starting the higher time frames, doing my analysis, then coming back down to the lower time frames and finding my entries on the lower time frames. So Kim, you might want to join for that live stream because that live stream is actually very, very insightful, to say the least. It opens up a whole new understanding of where to enter. But yeah, so yeah, that's essentially where I would have placed my stop. So let's say I got stopped out here. I'll be there. Thanks. No problem. So let's say I got stopped out here because I'm not going to sit here and lie to you and say, oh, I would have placed my stop loss up here because I can already see what price is doing. So let's say I did get stopped out here because I do like to, so let's say your end of your supply zone in this case here, because this is supply. Let's say the end of the supply zone is here. I would have added another, let's say 10, 15 pips. Okay. So let's say even if I added 15 pips, I would have got stopped out here. That's me being completely honest with you. Okay. Then me being stopped out here and seeing now price is showing its true hand coming back down, I would have re-entered somewhere in the equilibrium of this and had my stop loss. What I like to do is have it either halfway up a fair value gap, a recent fair value gap, or the full way of the fair value gap, assuming that it's not too big. Okay. And again, this will all be explained in the entries live stream. And I appreciate this doesn't sound very mechanical, but it will become to sound very, very pleasing, if you will, once we go through that live stream. Guys, I have literally less than 1 minute left of this live stream. I'm going to end it and send a new link. Forgive me. I'll see you guys in a second.
Okay, with that being said, I think we will continue. So, I'm going to be asking questions during the live, just so I know where people are at, and if you know exactly what we are talking about here regarding supply and demand. So, does anybody know what this is? Does anyone know what this represents? Yes, Matic. It represents a range. Now, ranging market, perfect. Liquidity, yep, that is a valid answer. Liquidity, because we have liquidity at the highs here and we have liquidity at the bottom here. Very, very valid answers. What would happen in this case if demand was to overpower supply? What would happen if demand was to step into the market here? What would we see price do? Anybody know? Yeah, Matic is correct. So if demand was to overpower supply, sorry, we would see this. So that is what would happen if demand was to overpower supply. And then does anybody know what we are looking for next? Because if anybody remembers from the previous video, this zone here, sorry, this here is called the initiation. Okay, so after the initiation, what are we looking for? We're looking for the mitigation. So does anybody know what would happen after this? Perfect. We would see a retracement back into our demand zone. Okay. So as soon as we have this range showing prices not going anywhere, okay, and once demand steps into the market, we would see price shoot up because obviously there's a demand. And demand, the simplest way to think of demand is essentially the buyers. Okay. So if demand was to overpower supply, so if the buyers were to overpower the sellers, we would see a huge injection of demand resulting in a huge spike upwards. And after this huge spike upwards, we would then come back down and mitigate our demand level. And this zone here is actually called the mitigation phase. So we've got the initiation, we've got the mitigation, and then does anybody know what comes next after mitigation? We fly again. Perfect. So after initiation, which is obviously hence the name, we initiate out of this range. We then get the mitigation phase, which is returning to this range, retesting, tapping in, whatever you want to call it. Mitigation is just a fancy name. We get that mitigation back into that range, and then we get the continuation phase, which is again easily described by flying again. Okay, so we fly back up to the upside again, showing that demand is in full control. So let's just mark this out for any of you who may be drawing this on. Let's minimize that. we get the continuation. Okay, so this is the three-step formula, as I like to call it, of getting these clues that these moves are about to happen. So I don't know if all of you were in the live stream, the initial live stream that we had about supply and demand, which will be pieced together with this one since it's been quite a long time since we've actually finished this module of supply and demand. But does anybody remember the example of the banks and a company in the USA who may need to transact a large amount of dollars for euros? So they would go to so let's say a company in America needed, let's say, some wood or some metal, some steel from a company in a country that uses euros. They wouldn't pay them in dollars, right? They would have to pay them in euros. So what would they do? They would call up their banks and they would then say to their bank, please, can you transact 10,000 lots of our dollars into euros and give us the best price, please? So the banks would then take that 10,000 lots from their client, go to the markets, obviously, and head to Euro USD, and they would put the first 5,000 lots. Why would they not put the whole 10,000 lots? They wouldn't, because you would have a huge amount of slippage, and also you wouldn't be able to get the best price for your client, okay? So let's say they would probably put 5,000, so half of it first into the markets, which then obviously this is that initiation. This is the first clue of a move that we could potentially participate in. Okay, so let's say this is the first 5,000 lots. So let's just mark that out. So let's say that's the first 5,000 lots. And then obviously that's when demand steps into the market, because we had a company who demanded their dollars be converted into euros. Okay, so that's the demand that stepped in. Price then retraced and tapped into our demand level. What do you think happened here? What did the banks do here? Does anybody know? Exactly. So they put in the remaining 5,000. So at this point here, they would have put the remaining 5,000. Why? Because price retraced and now they're able to get a better price. Because remember, even coming back to premium and discounting and discounted pricing, I'm sure all of you guys know what that is. But up here, where price is more expensive and compared to down here where price is more cheap, why would they then put 5,000 lots here and then put the remaining 5,000 lots here? It doesn't make sense, because they would have got a good price here, but then put the remaining 5,000 lots at a more expensive price up here. So it doesn't make sense. They would wait for that retracement back into that whole demand zone to then get a cheaper price. So what caused price to retrace then? So this is all in the previous live stream that we did, which isn't actually uploaded. So I'll just go through it very quickly. So when we have a lot of demand and not a lot of supply, price is more expensive. Okay, sorry, no, price is more cheap because people are actually able to afford it, or are willing to pay at this cheap price. But when price is more expensive, we will have a lot more people who are not actually willing to buy at this point. Therefore, supply steps in, the sellers step in, and they push the price downwards. That's what makes price retrace, okay? Because the suppliers now have a reason to sell their currency at a more premium rate. Okay, so obviously that gives the reason for them to sell, because they are able to sell at a more expensive rate. Okay, so that is what puts supply into control for now, until we get that mitigation into the demand, and then overall demand shows that it has the bigger hand, the more money, and it pushes price back up. Okay, Hope that answers your question. So let's just mark this out so it's not all empty. Remaining 5,000 lots. Okay, so I appreciate this is very messy, but I'm just drawing this for the people who may be drawing themselves to learn. So yes, we have the range, we have the premium of the range, we have the discount of the range, and we have the equilibrium of the range. The equilibrium is just a very fancy word for saying the 50% mark. Okay, it's just halfway in between. So when they put the first 5,000 lots, we get that initiation phase out, and this is our very first clue of that we may be getting a move that we can participate in, okay? Because then we get that mitigation phase. That mitigation phase is where we should be rubbing our hands together, happy because we now have a chance to get in long, okay? Again, it's not always going to play out, but majority of the time it does. You see this every day in the market. Supply respected, demand respected, but probably more often than not, you'll see them disrespected, but that's because people are getting in at the wrong area of the charts, that they don't understand the whole bigger picture of things. Okay, so you have to, of course, you have to implement market structure into this, internal and fractal structure into this, because then you have the whole bigger picture of things, and you're able to say, okay, hold on, no, it wouldn't be a good time to get in here because of such and such. Okay, so maybe, for example, let's say we're in an uptrend. Okay, would we then buy here? Would we buy here? No, because we know that we had that break of structure. And what do we expect after a break of structure? Does anybody know? Perfect. We expect a pullback. We expect a pullback into the discounted zones. Okay, so look, here we have a break of structure. And of course, you can keep longing here. No one's saying that you can't. You just have to be very aggressive with your targets. I would even say don't even do long-term trades here. Maybe do scalps, because as soon as we get that break of structure, we are now expecting that pullback to back into discounted zones for demand to show that it is still in power and keep going up. Okay, and just another example as well. So here you can see that prices come, pull back into the discounted zones of here, broken structure showing that that trend is continuing and demand is still in power. And we still continue for a while up here. But you guys will see every day in the markets that we may even just come up a little bit and then pull back. And then this time we go up a lot and then pull back. And then pull back. And then just a little bit, pull back, and then a lot, So it's more of implementing fractal structure and internal structure, because then you'll have such a big understanding of why price action is doing what it is. And what I mean by that is just so everyone's not left in the dark. Let's say we've got a big swing leg up, okay? And then we pull back into discounted zones. We could then get a lot of internal structure heading to the upside, and then we'll get a fractal pullback. I'm hoping you guys remember what this is from the last live stream. If you don't worry. It's been a long time ago, so you can be forgiven for forgetting. Let's say we get all this internal structure on this up leg, and then we get a fractal pullback, and then a fractal continuation, and then we get that fractal change of character here. Okay, so remember, we get this fractal pullback, so then this becomes our fractal high. We then get that continuation to the upside. So where is our fractal low? Our fractal low is here. Then we get that fractal change of character. If price then gets that fractal change of character, does anybody remember what that signals? Not necessarily. So a fractal change of character doesn't necessarily mean a dump. It just shows that we are now getting that internal pullback. Okay, because remember, on a higher time frame, so let's say we're on the daily time frame right now. A fractal change of character on the daily time frame on the 4-hour would actually be an internal break of structure, an internal change of character. Sorry. Okay, it's showing that we're getting that internal pullback on the higher time frame. So my higher time frame is the daily. If I see a fractal change of character on a daily, I know on the 4-hour that's an internal change of character, and we are now getting that internal pullback. But what happens now once we have this fractal change of character paired with an internal break of structure or an internal change of character, whatever you want to call it. What does that signal? Market structure shift. So not really a market structure shift, but it basically signals that we are now getting that whole swing leg back into the previous discount. Okay, so this is where you can now predict, quote unquote, that we are getting those swing pullbacks. And why I say this is important is because remember, back in the previous example of where price could do this, continue for a long time after we get that break of structure, pull back, get that break of structure, and maybe go above just a little bit, and then come back down. Okay, maybe not that much. Yeah, so just a little bit and then come back down. You will be able to anticipate this happens once you understand fractal change of characters and internal change of characters also, and what they signal. And this is all going to be uploaded. Today we are definitely going to be finishing the institutional supply and demand live stream, so you will be able to go on that YouTube video and watch all of those videos there. But yes, so once you understand fractal structure, internal structure, and swing structure as a whole, you will then be able to anticipate that this next swing leg back to the downside to facilitate this demand being hit for then price to continue back. You will anticipate this just by knowing fractal structure and internal structure. That's why, for me, the Three Musketeers of Structure, the live stream that is uploaded onto YouTube currently, I believe it's a 2 hour long video. That is a video that, in my recommendation for you guys should watch that video endlessly until you really understand it, because that is the key, along with multi-time frame analysis and liquidity and supply and demand concepts. When you merge all of those together, you really do have such a high understanding of why price is doing what it is. So let's continue here. Okay, so we'll just come back to this one more time before we move on. So we get that range, of course. Okay, so that range showing that price is not really going anywhere. We have that pause in price action. Then we get that initiation phase out of the range. What do we get then next? The mitigation phase back into the range, and then we get that continuation back out of the range. But do you guys know how we would refine this POI? Because let's just keep it simple. Let's say we enter on the edge of the box. We have our stop loss just below the range, and we aim for the week high. Is that a good risk to reward? Would you be happy coming to the markets, doing all your analysis to just get a one-to-one risk to reward? Would that please you? Is it worth it to get in that trade for a one-to-one risk to reward? I will never take it like this, says Zoran. Good. Anyone else? Would you be happy to enter a trade just to get the same amount of money that you risked, a one-to-one? I'm going to speak for you. I think you wouldn't. I think you wouldn't. I think it speaks for itself. Matic says money is money. Yes, money is money, but at the end of the day, when you're putting in all your blood, sweat, and tears into learning Forex, you don't want to be getting on these low income trades where you're getting a one-to-one. Does anybody then know how we would refine this zone to get a bigger risk to reward? And if anybody doesn't know what that means, maybe we have some newer traders. Risk to reward is essentially where you have a much smaller stop loss than your take profit area, so that thus then you have a bigger risk to reward. So let's say if I'm risking 1% on this trade, and I'm hitting final take profit, compared to risking 1%, I then gain 5.23%. Compared to this one, risking 1% and making 1%. Which one seems better? Obviously the right one, no? So does anybody know how we refine this zone to then get a better risk to reward? Does anybody know? Aha. Zoran has hit the nail on the head. we look at smaller time frames for an entry. Okay. So listen, this is actually some key information that I'm about to tell you guys. So for multi-time frame analysis, okay, we have our higher time frame, which is for what? To look at the direction of where price is going. Then we have our median time frame, which for me is the 4 hour, okay? And that is just for simply identifying POIs. So let's say we have seen this whole move up on a daily and we can see price is now bullish. We then scale down to the 4 hour. So let's say this, what we're seeing all here is the 4 hour. And we see this POI. I then would mark out this POI on the 4 hour, okay? And I see that if we tap into this zone, I now know that we're looking for buyers going to the upside, okay? But again, as I said, we don't want to take this whole range because then we are risking 1% and only going to gain 1%. We don't want to do that. So then how do we get a better risk to reward? As Zoran said, we then go down to our lower time frame, and my lower time frame is the 15-minute. And what I would do is I would look for those pivot points within this whole demand zone to then get a better risk to reward. Okay. So furthermore, let's say that we are now looking at the 50-minute time frame from here. You could then get your Fibonacci tool, and you now know that this is the 50% of that whole leg, okay? Is anybody going to take a demand zone here to get in for a buy? Yes or no? Would you take a demand zone here? Forget that you can see what price is doing here. Let's say that we can't even see price doing this. Let's say it's just here. Would you take a buy here? Joe says no. Suraj says no. Zoran says no, only in discount level. Zoran, do you want to teach today? Man, you're coming up with all of the answers. Yes, perfect, exactly. We wouldn't take this range just because it's in the premium. We don't want to buy in the premium. We want to buy in the discount. So this range can automatically be taken out of the books. Let's say we have a range here, and a range here at the extreme. Which one is the most high probable range to buy from? Does anybody know? The one just below the 50%, the one in the middle, or the most extreme? Matic, perfect. Matic says the lowest. So the most high probability setup is the extreme, is the most extreme demand zone. And why? Why is this the most high probability one to take? If we do this, what do we then get? Knowing that this is now a strong low because we've broken all of this, what do we get now here? This is a change of character, right? But what do we expect? Once we see this strong low, what do we expect to happen from this strong low? We expect it to hold, right? We don't expect it to be broken. We expect it to hold. That's why this is the last demand zone that actually has to hold if price is going to remain bullish and if demand is going to continue to stay in power, in control. That's why this is the most high probability setup. Just because of that, just because we now know that this is a strong low and price has to respect this low if demand is going to stay in power, okay? But what happens if we come to this one and we start to see on the 15-minute that we have something like this? So let's say we've come down, okay, we've tapped in. We know that this is a strong internal high. Why? Because it broke the internal low. What happens if we get that here? So let's say we can see that. Let's say we can see that here. What do we do? Because remember now, this is now a weak internal low, strong internal high. We've broken that low, so this remains a strong internal high, and we've broken it for a change of character. Perfect. We then go to an even smaller time frame. So in that sense, it would be the 5-minute, and we would then look for that demand zone here to then enter on the mitigation and then go back up. Okay, so let's just draw it here so we're not confusing everyone. So let's say you know what, apologies. So let's say we're doing this, tap in, strong internal low, we break it. Okay, so now we know that price is showing bullish behavior. As Zoran said, we then get into the smaller time frame, smaller than the 15-minute, to be able to locate that POI, which would be this demand zone here. And then we get in for that long. Okay, so this is how, even if the extreme isn't met, this is how we can then know, okay, this demand zone is being respected. I don't know when to get in. Let's look for those entry models. Okay, so let's say you're on the 15-minute time frame and you don't see these clear internal highs, you could just go to a lower time frame and you will start to see those things. And this will even come into a multi-time frame analysis, because look, let's say this is the daily time frame. We have one leg. Okay, this is now the 4-hour time frame. Can you see the contrast here? One daily leg is now a trend on the lower time frame. So this is let's just change these colors so it's not so confusing. So the black line is the daily time frame. This blue turquoise line is the 4-hour time frame. What is the 15-minute time frame going to look like? We're going to have smaller trends within here. Okay, so the internal structure is bullish. Okay, then we flip bearish to facilitate this downwards movement. Okay, then we flip bullish again so that this internal high is broken to then get this up movement. Okay, then let's change this to, let's say, green. Oh, that doesn't look, yeah, there you go. That's a bit more clear. So look, you've got the black line, which is the daily. You've got the turquoise line, which is the 4-hour, and then you've got the yellow line, which is the 15-minute time frame. Okay, and why I say this is because if you don't see that internal high on the 15-minute time frame, do you think you're going to be able to see it on the 5-minute? Yes, because it's a lower time frame. You're going to be able to see those pullbacks. So that's why if you don't see it on the 15, you can then just go down a time frame to the 5 and you will be able to see it and then enter in on the demand mitigation and aim for this week high. Okay, is so far so good? So far so good for everyone? Yeah, perfect. Cool. So let's delete all of this. Now, back to you know, we'll just cover this refinement just one more time. So let's say we've got this range, we get that initiation out, and we come down here to mitigate, and then we get that continuation. And I think straight after this one, we'll try and find a live example of this just so you can see what it looks like on the actual charts. So yeah, we get that initiation phase out and we come tap back in. As I believe it was Matic or Zoran said, we go down to the lower time frames and we will be able to cherry pick a refined POI within there. And instead of getting long on the edge of this box, to then aim to the bottom of this and to aim for the week high, we could now enter here, okay, at the bottom of the demand and get in, and look, we have a 1 to 7. And if you risk 2% on this trade, considering it is a high probability trade, you can actually be confident that this trade is going to play out. Whereas 2% on this trade, you have passed phase 1 of any funded account within one trade. So this is why, for me, just in my opinion, I'm not disrespecting anyone's strategy. SMC, this strategy that I'm explaining to you is the most, how can I explain it? It's the elite strategy, in my opinion, just because I've seen these setups play out a majority of the time. I'm not gonna sit here and lie to you and say it's a 100% win rate. It's not. But these setups, they play out a majority of the time if you know what you're doing, if you know how to merge market structure, internal, fractal, and swing together with supply and demand, with liquidity, with everything. As soon as you can merge those all together, you have such a big understanding of why the market is doing what it's doing. You will be able to enter in a majority of the time at the correct place. Okay. And I'm not saying you're always gonna have 100% strike rate. No, no trader does. I'm just saying you will improve how many trades you win compared to losing. Okay. Zora says challenge pass. Yeah, like it's so it seems so easy, but it's not. But I'm just saying, like, if you was to see this trade play out and you get in at a 2% risk, knowing that you're gonna get almost a 7R, and you know this is a high probability trade, you you've passed phase one in one trade. But these will be swing trades then, right? No, not necessarily, because you have went to the daily time frame. Okay, you've went to the daily time frame. You've saw what the daily time frame's objective is. You've then gone to the 4 hour, saw a demand range. You've tapped into the demand range on the 4 hour, but then you go to the 15 minute, and then you've refined your demand range and aimed for maybe you want a fixed risk to reward, maybe a 1 to 3, a 1 to 5, or you aim for that high, a high within the 15-minute time frame. That trade can be passed, can be hit, can hit take profit within few hours or a day or two. It's not necessarily big swing trade that you're staying in for weeks on end. Like even a few days ago, I believe it was Monday, we got in on a trade on Euro USD using this exact same uh skeleton of how to take trades. We got in exactly the same. Okay, it wasn't even a supply, it was a demand, and we used this exact same strategy. Okay, I saw the range on the daily. I saw that initiation out on the 4 hour. I located a POI. I draw out the POI. I saw that the POI was then mitigated. I then went down to the 15-minute and waited for further mitigation on my refined POI, and price soared up. And I believe it was within 4 hours we hit a almost a 1 to 3. So even if you was to risk 2% on that trade, you would have made 6%. You would have made 6% in one trade. And that's not me showing off. No, I'm not showing off to you guys. I'm just saying, like, this is very, very possible. You could pass accounts in one trade, and it's as real as that. But anyway, I'm sure you guys know. I'm sure you guys know now. Regarding what I'm teaching you here. So we can go on next to confluences. Okay. So confluences for a trade regarding supply and demand. So market structure, we could look for, is price bullish, okay, or is price bearish, okay? And why I say this is because if price is bullish, are we going to be looking to trade from supply zones? No, we're going to be looking to trade from demand zones. And vice versa. If price is bearish, are we going to be looking to trade from demand zones? No, we're going to be looking to trade from supply zones. Okay. Other confluences, and I hope you guys are writing this down. I'm gonna write here. Okay. Then the second confluence would be premium to discount pricing. Okay. So is it well priced? And I'll explain what I mean by that in a second. So what I mean by that, again, even though we've gone through it once, I will just go through it again. Is it well priced? So from this high to this low, we know that we have now traded into the premium while we're going to the downside. So is that good? Yes. So let's say we see a supply zone here. Okay. So is market structure bullish or bearish? It's bearish. Do I trade from supply zones or demand zones? Supply zones. Okay. Now, second confluence. Premium discount pricing. Is it well priced? Yes, it is well priced because we have traded above the premium. Okay. Now, in a bullish market sense. Sorry, I've drawn that one wrong. So from this low to this high, okay.
Market structure, is price bullish or bearish? Bullish. Do I trade from supply zones or demand zones? Demand zones, okay? Now, premium discount pricing. Is it well priced? Yes. Why is it well priced? Because we have hit a demand zone in the discount, okay? Does that make sense for everyone? So this is just the first two confluences, okay? Now we'll add a third confluence. And remember, guys, what I'm showing you here, they are nice to have when you have when you're looking at a trade setup that you potentially want to get in. These confluences are nice to have, but you don't have to have every single one of them, okay? So they're nice to haves, not a deal breaker. Okay, let's continue. Apologies, guys. Are we recording? Yes, we are recording. Okay. So yes, first two confluences that we've done. Market structure, is price bullish or bearish? We're bullish in this sense. Do we trade from demand zones or supply zones? So again, if we're bullish, we trade from demand zones. Premium discount pricing, is it well priced? Yes, because we've got a demand zone within a discounted price. Liquidity. So this is the third confluence. Has it swept any liquidity, or is there inducement? Okay, and I know here it's just one leg up, and this is why this is not the best example because we've just got line graphs. But in the sense of what I mean is, let's say we've got this leg up, okay, and we've done this, okay. So let's say this is all one daily leg up, okay, or sorry, a 4-hour leg up, and we then come back down into discounted pricing. So let's just get out our Fibonacci tool from the high to the low. Okay. Anything below the 50% mark, again, it is a valid demand range because it's within the discount, okay? So this being in the discount, you would be forgiven for thinking that we could get in here. But why is that a low probability trade? Does anybody know? It's within this. It's within this. Does anybody know? There's a lot of liquidity below. Yep. Need to sweep sell side liquidity for the next move. Perfect. So this it's inducement as well. Okay. So you could see like we've got liquidity here. People would be so fixated on the fact that there's a demand zone below the 50%. We're bullish. They're going to be so fixated on this. We may get a small reaction from it because there would be orders here because that there was demand here before we stepped up. Sorry. But then we sweep to the downside. And then we mitigate the most extreme demand before going to the upside, okay? So that's inducement and that's liquidity basically in a nut, well, not really in a nutshell. It's just one example, two examples of liquidity. So yeah, confluences. We'll just go through them slowly one by one for the new people that have joined. Market structure. Is price bullish or bearish? We're bullish in this sense. Do we trade from demand zones or supply zones? We trade from demand zones. Discount and premium pricing. Is it well priced? Yes, it's well priced because we are now tapped into the discount and there is a valid demand there, okay? Has it swept liquidity or is there inducement? So let's say we come down and let's say we see this here. Are we going to enter in there? We may enter in if we see something like this. So let's say we get a move down into there. And then we get that internal change of character, and then we see that there's a fresh demand zone here, and then we go, yeah, okay, no problem. But a majority of the time, you will see that we have inducement here. And the reason we will have inducement from the banks is that they want you to enter in on the wrong side of the market. Okay. That's why we always be patient with our trades and we are always looking to enter on the most extreme demand or supply. But that's not to say that we can't enter in on the demand zones or supply zones that are above or below the most extreme, okay? It's just to go to say that we need to be careful of when we are entering. And why I say that again is because we may get something like this
where we have a strong pull down, we get an internal high, make a new low, but then we break that high for a change of character. Then we are perfectly well within our rights to then enter in on this demand zone and head back to the upside, okay? But that's only if this entry model plays out. If internal structure stays bullish, are we then gonna have the idea in our head of getting longs until we reach here? No, because internal structure is staying sorry, not bullish, bearish. If internal structure is staying bearish, we're gonna wait for that most extreme POI to be met. Does that make sense? Perfect. Okay, another confluence here. So mitigated or unmitigated? So has it been mitigated? Okay. And why I say this is, let's say we get a let's say we get a price moving up, okay? And then we have a demand zone here, but you know what? Sorry about that. Let's move this down a bit. So this is not the best example, just because I can't draw it out the same way it would show on the markets. But let's say we've come up, we've pulled back into discounted zones, and then we've came up, but within here, after we've made this fresh demand zone, let's say we wicked down. So let's say before we made that change of character, let's say we wicked down into like the equilibrium of the demand, and then we come up. Is this zone mitigated or unmitigated? Does anybody know? Mitigated. Would we place all of our trust on a mitigated zone or an unmitigated zone? Unmitigated, exactly. We want to look for unmitigated zones. Why? Because they have all of the orders still within there. So in this sense here, we've had a bullish up movement, bearish down movement to then facilitate this demand zone, and then we've pulled back up. But instead, like while we're moving back up, we then get a wick, a deep wick into the demand zone, okay? All of these orders which have created that demand push have now been filled to then obviously get that further push up. That's why now, if price was to then come back down into here, although this plays out, I'm not placing all of my trust into this demand zone because it's mitigated. Okay, so does that make sense for everyone? And I'm going to show you how we implement that into confluences. It's quite simple. So we'll just go through this one more time. Market structure is price bullish or bearish? It's bullish, okay? Do we trade from supply or demand zones? Demand zones, okay? We're bullish, so we trade from demand zones. Premium and discount pricing. Is it well priced? Yes, it's well priced because we are trading below the discount, okay? Below the 50% mark. We are within the discount. Liquidity, has it swept liquidity and is there inducement? Okay, so you can imagine this whole movement within this leg. Okay, so just imagine this movement within this leg. There is inducement. Okay, so we now know not to place all of our trust to enter within that demand zone because it may be an inducement. Okay, so we would look to then enter in on the most extreme. But again, if we get that bullish change of character scenario on the internal structure, then yeah, we could look to get long within here. But if we don't and we see the internal structure is staying bearish, we then want to enter in on the most extreme demand or supply. Again, mitigated or unmitigated, has it been mitigated? In this sense, we would say no, okay, because we've had a nice up movement to the upside before coming and then mitigating. So this is a completely fresh zone that we can place trust in because all of the orders that created that demand is still there, okay? Is that so good so far for everyone? Perfect. So these are some confluences that we can have in our trading to really be quote unquote confident that we are getting in on a high probability trade. Sorry about that, guys. So yes, these are all some confluences that we can have to get in on a higher probability trade, okay? And it's not to say that we need every single one of these. No, we don't. It would be nice if we had every single one of these on a trade, because then we know that we get in on a very high probability trade. But again, if one or two are missing, it's not the end of the world, okay? Can you repeat it, please? Which one should I repeat? Do you want me to go through all the confluences again on this example? Yeah, okay, cool. So market structure. Is price bullish or bearish? So that's the first confluence. Is it bullish or bearish? Okay, so this is just a confirmation of what price is doing. Is it bullish or bearish? In this sense, we are bullish. Okay. So do we trade from supply zones or demand zones? We trade from demand zones. Okay, so we know that we have a completely unmitigated demand zone here. It's well priced because it's below the discount, below the 50% mark. Okay, so is it well priced? Yes. Liquidity. Has it swept liquidity? Is there inducement? So let's say you can imagine this whole movement within this leg on the lower time frame. Is there inducement? Yes. Okay. So we basically want to assume that we're going to enter in on the most extreme POI, which would be down here. But again, if we get that bullish change of character entry model where we get the internal, so you can imagine this here. So let's say we've come down, come up, come down, but then we've broken that high. We then know that we can enter in on this demand to then get that movement upwards. Okay. Are you trading in a specific time or when you see a setup? So yeah, essentially, I like to trade when there's movement within the market. So I'll trade in the London session and I'll trade within the New York session. Even if I see a 10 out of 10, this may seem quite weird to you guys, but if I see a 10 out of 10 setup, which is very, very nice, but it's in Sydney session or something like that, anything outside of London session and New York session, I'm not going to take it just because I can't trust the volatility. I can't trust that price is going to move as quickly as I want it to in a direction that I want it to. Okay. Does that make sense? All right. Let's delete all this. Okay. So now we're going to go through quickly how to basically validate a supply and demand zone. So we have two core methods to validate a supply and demand zone. Okay, so we'll just write this down. So the first one is, did it break structure? Okay, so that's the first one. And the second one is if it made another zone fail. And we will go through this. So what do I mean by this? So did it break structure? So let's say we have demand stepped into the market, okay? Supply stepped in momentarily to then push price down because there is too much demand, not enough supply. So everyone is so happy to buy, but then price gets expensive, and now there's the demand sort of steps off and supply steps in because now they have a reason to sell at such a premium price. Okay, so then price pushes back down into the demand zone, a protected low. There's money here, so then demand or the buyers, to simplify it, have a reason to step back in and push price. Okay, so this demand zone here, sorry. There's demand in this zone here, okay? Is it valid? Yes. Why? Because it broke structure. This is how we know that there's institutional backing within that demand. Okay. We know that there's money in this demand because it takes a lot of money to even move the market by a single pip. How much more money does it take to actually push it up hundreds of pips, maybe 50, 100, 150 pips to then break structure also? Because remember, there's liquidity here also. There's money here also because supply stepped in, but demand is overpowering it with more money within that buy movement. So it broke structure. Okay. So that's one of the core methods we use to validate a supply and demand zone, because now we know that there's money within here because it caused the break of structure. So now when price retests that, we can be sure to enter in long. And not only, and this is why I say market structure is such a key thing to learn, okay? Because look, market structure wise, we've got this low, made a high, we've pulled back, made a new high. So this is the lowest point that caused that break of structure. So now we know that this should be a strong protected low, okay? We've come down and respected that. This low is strong, so we don't break it, and then we come back up. Now we overlay supply and demand into it, okay? So we've got a very nice strong supply zone, sorry, demand zone, tapped into the demand zone. Not only that, we've respected the low and we've pushed up higher. Okay, does that make sense? Hi, Abdul Rahim, how are you? Matic says 50-50. Okay, so we'll go with it. We'll go into it one more time. So two core methods to validate a supply and demand zone. Okay, did it break structure? So let's say we've came up to the upside. Okay, supply has stepped in, or you know what? Let's not even include that because it's too many words. Maybe it's confusing you. Prices came up, we've come down, and then we've caused the break of structure. Okay, how much money did it take to come from this low to then push all the way up and break this structure? How much money did that take? It took a lot of money, right? Because it even takes a lot of money to move price by one pip. So how much more did it take to push price all the way up here to break this structure? A lot, a lot, a lot more, right? So we now know that demand stepped in here. So is it a valid demand zone? Is it a demand zone that has a lot of money behind it that we want to get in on? Yes. Why? Because it caused a break of structure. Okay, does that make sense? So now we know that there's money here. We know that this area is protected. Maybe that's another way you want to look at it. This area is protected. So they don't want price to come and just storm through here and take all of the orders. No, they want to fill the orders and continue that demand chain to the upside. Okay. And you could even say from here, look, let's just rein this in a bit. Price has pulled down, supply has stepped in momentarily because again, the demand has stepped in. So buyers, 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 buyers. Price got a bit too expensive, so the buyers weren't really happy to keep buying here. So supply has stepped in because price is now at a more premium price. So they'd have a reason to sell at this price. That's what pushes price back down. Okay. Now again, what did no, that was the example we've already gone through. So the same example here. We've pushed back down, okay? And then how much money did it take to cause that break of structure? A considerable amount of money, right? Because again, it takes a lot of money to move price by even one pip. So how much more did it take? How much more money did it take to actually come up much more than one pip? But not only that, break this high where there is supply here. A lot of money. So now we know that this is a valid demand range, and we could trust that when price taps into it, we may move back to the upside. Okay. Pairing this with market structure, pairing this with internal and fractal, you can then see why price is doing what it's doing. Is there a chance to make a fake breakout? Yes. Yes, there is always, always, always the chance of that. So price may wick all the way down here. So price may wick, take up all the orders, but then still continue to the upside. So this is why I say fractal internal are always a key role in this. So let's just delete these. What I mean by that is within all these legs here. So let's say this is daily. All these legs are daily, yeah? We scale down to the 4 minute. What do we, sorry, the 4 hour. What do we see? We see internal structure. We see all of these highs and lows forming. If all of these zones, sorry, if all of these pullbacks stay bearish and we don't even get one sign that price may want to break a high to flip bullish, what can we anticipate? Common sense, what can we anticipate? That price wants to stay bearish and break that high, break that low. Potentially, yeah, we could say it's a market maker movement because the market makers could have stepped in here and kept price bearish to break this low. And again, remember, we don't have to like break this low and then, you know, continue to the upside. Even though that does happen, we don't have to do that. We could break this price, okay? So then what would that show? That would show that we have a daily change of character, okay? That would show that price has now flipped bearish. What would we then look for? We would look for price to come back up within our discounted range, hit a supply zone because now supply has stepped in, and then look to go short. Does that make sense? Perfect. Abdul Rahim says, can you please explain how to use premium and discount Fibonacci replacement in trades? Okay, so let's go to the live charts very, very quickly. We're going to go to Euro USD to a trade that we took on Monday. Apologies, 1 second. I'm going to have to go to the Discord and find the coordinates. Yes, this was the trade. Okay, so we got in here at this demand zone. Okay, and we aimed for a 1 to 2.6, was it? So it was this trade here. So we got in almost no drawdown, okay? And it was a, how many pip stop loss? It was a 17 pip stop loss. So we had our stop loss just below the demand range, okay? And then we had a 45 pip take profit. So yeah, we aimed just about here. Entry was 1.05515. So let's just change that. Entry point 5515. Profit level was 5954. And stop was 5338. Okay, so that was the trade essentially, and we got a 2 point. It says here I've got a 2.6, and yeah, I did make a 2.6 because that's what the profit came up as. So I don't know why it's showing a 2.5 here, but anyway, regardless, this was the trade that we caught. Okay, so look on the daily time frame. Remember, bearing in mind, price was here when we took that trade. You can see the buy tool here. Okay, so why did I then look to buy here? Because look, internal structure wise, we've fractal and internal. We've got this fractal continuation going down. Okay, and I'm gonna go through this very slowly. I did upload the breakdown video on YouTube, but we'll go through it here in the live stream. All of these candles, they break the low, okay? So fractal wise, all of these lows of the candles, the wicks or the bodies, they close below each other, okay? So all of this is one fractal continuation to the downside until we get this black candle here, which pulls back, okay? So as you can see here, the low of this candle, this black candle, doesn't break the low of this previous candle. So what is that? That's a fractal pullback, right? So now we need to find our fractal high because now we have this fractal pullback. We know that this line here is our fractal low. So how do we find the fractal high? We have to find the nearest candle that failed to break the previous candle's high, which is obviously this candle here. This candle, sorry, low. This candle didn't break this candle's low, okay? So then this would be our fractal high. But because this candle traded higher, slightly higher, it doesn't make sense to put this as our fractal high if this is higher, right? It's common sense. So this is our fractal high in that sense. Until we get that fractal continuation, we get that continuation movement. Okay, so now what do? We look for a new fractal pullback to then look for our new fractal high and low range. Okay, so it isn't until this point here that we get that fractal pullback. So we know that this is our fractal low. So what do? Same scenario here. We look for our fractal high using the same mechanism. So this candle breaks this low, this candle breaks this low, this candle doesn't break this low. So that is our fractal high, okay? Then we get a fractal change of character, okay? Because with fractal structure, we only need the wick to break to consider it a break in structure, okay? Compared to swing and internal, where we need a full candle body closure to consider it a break. So after we get that fractal change of character, that's only one step of the ingredient to prove that we are now getting that upwards movement, okay? So bullish pressure has started to step in. Fractal change of character, again, only signals that we are getting that internal pullback, which in the end we do. What does this now become? This becomes an internal high because we have that fractal change of character, right? So this becomes an internal high, right? Now, we've pulled back, broken that internal high. So we get an IBOS, internal breakage structure. And we know that because we now have a candle body closure. So now zooming out of that, we have that two-step sign now that price is going bullish, but not even including this, what do we see here? Internal change of character. Price is now going bullish. And we can see we've pulled back into the low of this leg. Okay. So why didn't I mark out this demand zone? Because we heavily mitigated it before moving up. Okay. So I included this whole, oh, it's already drawn on. I included this demand range. Okay. So even though we did mitigate before moving off, it wasn't as much as this one. Okay. So we've come up, pulled back down into it. So we've really mitigated deep now into this demand range. So then I saw price now coming up. You see these wicks, we've got the rejection to the downside. I saw all of this. I knew like pairing these rejections to all of what we've just spoken about here, fractal change of character, internal breaker structure. Not only that, the internal structure is now going bullish. I then went down to the 4-hour and I saw it even clearer. Okay. We had pulled back, pulled up, pulled back, pulled up, pulled back into our demand range. Okay. So I saw now that we could be heading back to the upside. So I looked for a perfect area to enter in on the 15-minute time frame, which just so happened to be that we entered on this very clean demand range. Okay, so this is the last candle before that true demand stepped in. We pulled off, pulled back into it, and then we continued up to the upside, and we hit a nice 1 to 2.6 trade. Okay, so that was essentially the trade, and the question that Abdul Rahim asked is, can you please explain how to use premium and discount Fibonacci? So look, in this sense here, this is the low, this is the high. So we draw our Fibonacci from the low to the high. And look, we have a very extreme demand range, which is below the discount. So this is a very high probability trade, correct? Very high probability trade. We're below the discount. We know that it's an unmitigated zone on the 15. We've pulled up high, considerable amount of pullbacks to the downside, tapped in again below the 50% mark. So we know we're in the discount, and we've pulled back up to the upside. Very nice trade. So that's how you implement on the live charts, premium and discount pricing. Because again, look, we have a very large demand range here. You could make this smaller by going on the 15-minute time frame. You could maybe, whatever. But does it make sense to enter here? No, because we're in the premium. And we can see if we did enter here on the edge of the box and had our stop loss here and aim for this high, we would have got stopped out. That's why you wait for that discounted zone to be traded within, and aim for one of those demand ranges within the discount. Okay, so I hope that answered your question, Abdul Rahim. Now I understand why I was losing trades. Perfect. So I really pray that you guys take away some clarity from this and you really learn from this. I hope you're taking your notes. I really do, because I want nothing but success for you guys. And to be very, very honest with you, you're not going to get that success until you really knuckle down and understand that this isn't a game to be one foot in and one foot out. You really have to study and really have to to go through this, you know. You really have to really, really go through this with your whole heart to be able to leave this game profitable. It's really clear. Thank you so much. No problem. Right. So we'll go through 1 second. All right, what was the on the daily? Yeah, here it is. Okay, so I showed you already one of the core methods to validate a supply and demand zone. Did it break structure? So we showed you a bullish example. Now let's go through a bearish example. Okay, so we know now that we've came down to the downside, made a low, pulled up, and we've broken that this low. So that made it took a lot of money to break that low, right? So we know that there would have been some nice supply within this range, because that supply, sellers, simplified version of saying supply, the sellers stepped in to break that low. So we have a breaker structure. And as I've said repeatedly, it takes a lot of money to cause this to happen. Okay. So when price pulls back up, we can have full assurance that it's going to be respected. Again, not 100% of the time, but the expectation is that it will be held, because of the fact that not only it's a supply zone, we have the swing structure staying bearish. So we expect that this high won't be breached. We expect that it won't be breached. We expect that it will hold. And then that's where we overlay supply and demand into it. So this supply zone, we know there's a supply zone here. Why is there a supply zone here? Because it caused a lot of money to push this price down to cause that break of structure. So when price retests this, we have already just off of market structure and supply and demand, we have two confluences. We have two confluences right there that this zone is a high probability zone that will hold. Okay. Then we can overlay premium discount pricing. Okay. So that's a third confluence. Draw your Fibonacci from the high to the low. Is it well priced? Yes. Why is it well priced? Because we've traded into the premium. Okay. If it only wicks above the inducement, is it still valid for sales then? What do you mean? Oh, okay. Sorry. Yes, yes. So if it only wicks above but fails to close, if we fail to get a full body closure above this high, sorry, Zoran. Yes, you're correct. If we fail to close above this high but wick through and continue to the downside, market structure wise, what do we need mechanically to consider a change of character or a break of structure? A candle body closure. So if we only get a wick above, no matter if it's a wick all the way up here for a news event or just a small wick, if it wicks but doesn't break it, our mindset still is bearish. Okay. So yes, it's still valid for sales, even if we break this supply, because even as somebody else asked here, who was it? It was Anmar. So Anmar asked, is there a chance to make a fake breakout? Yes. This is one of those examples. We have a fake breakout. So people are thinking, okay, we're getting a change of character here. We're going to the moon, but no, we get up, we wick above it, but then the wick retraces. And when that 4 hour or that daily candle closes, we only have a wick above that high. Therefore, we are still bearish. Okay. Hope that makes sense, guys. Guys, we literally have 2 minutes left on this live stream, so I'm going to end it and send a new link into the Discord. Okay, I'll see you in a second. And what time frame do you use then? I usually use the 1 hour time frame, but it seems like at the 5 minute it could be a candle close on it. Yeah, so essentially with market structure, you want to be only looking at market structure on the higher time frame. So I look at the market structure on a daily, just for that clear direction.
Okay, I'm not gonna go to the 4 hour and see that the 4 hour, because remember, a wick on the 4 hour could be a candle body closure. Sorry, a wick on the daily could be a candle body closure on the 4 hour. That's why I don't like to include all of that as noise. Okay, so on the daily, I use that as clear direction. Okay, for showing, okay, we haven't closed above that high, we're still bearish. I hope that makes sense. Is this confirmations are enough to jump into a trade? Yes, we're gonna go through this. Let me just send a new live stream because we've got less than a minute left. Okay, I'll see you guys in a second. Right. So that was the bearish example of the two core methods to validate a supply and demand zone. Did it break structure? Yes, it caused a break of structure. Okay, so it's a valid zone. So now let's go to the second core method to validate a supply and demand zone. If it made another zone fail, okay? So does anybody know what a flip zone is? No. Okay. Anyone else? Fermin says, I'm so new. No problem. We'll go through this very diligently so you guys will understand. And again, as I said, all of these live streams are recorded and they will be posted up onto YouTube so you guys can do further studying in your own time. Okay, so it seems nobody knows what a flip zone is. I'm sure somebody knows what a flip zone is. I did get a few questions on when we're going to be covering flip zones in our previous live stream, so I hope those guys are in the live stream right now so we can go into it then. Regardless, anyway, as I said, it's recorded, so they'll be able to view it. So a flip zone is essentially, so let's say we have a, let's just draw it on so I'm not just speaking words. What's going on, guys? Sorry to interrupt your studying, but I do think it's very important that I correct myself with what you're about to see. So while editing this video, I saw that I had actually drawn on a flip zone incorrectly. Okay, so this is the correct thing that you should see. And then just imagine what you're about to see now later on when the live stream continues. Okay, so this is what a true flip zone would look like, okay? Because then obviously you've come down, made a low, made a high. Supply has stepped in again to show it's had the power. We've come up into that supply zone and we should, in theory, retest that supply zone and come back down to make a new low. But instead we get a small reaction, break up, causing the supply to fail, leaving a fresh demand here. And we come in, tap the demand and then head to the upside. Okay, that's how a supply zone should look, not what you're about to see. Okay, sorry guys for that, but yeah, just thought I'd correct myself. So let's say we have a pull down, okay, a push up, and then a pull down. But what is the job of this supply zone? What is the job of this supply zone? It's the job is to make a new low, right? Zoran says he's done a Google search. In smart money concept terms, a supply zone is where you have your bearish order block and demand zone is where you have your bullish order block. But now, what is a supply and demand zone flip zone? Basically, a flip zone is an area where there is an interaction or exchange between a zone of supply and demand. Yes, that's correct, but that's only one part of it. So we'll go through. It's cool. It's not bad. You're coming with some valid input, so it's good. Maybe you guys can write down what he's put in your notes and then add to the notes what I'm about to show to you. Carl says flip zone is aggressively goes the opposite way. Okay, yes, but again, that's only one part of it. So we'll explain everything else now. I am new here, but I would prefer if you show us on a real chat. Yeah. So let's on a real chart. Okay, yeah. So we will go through all of this on a live chart eventually within this live stream. Okay. So we've pulled down. Okay, demand has stepped in momentarily to get that pullback. Then the true supply, which is in power in a downtrend, stepped in again for that bullish movement down. But listen, what is the job of a supply zone? The job of a supply zone is to cause that break of structure to come back down, right? But what happens if we don't break that low, right? And we come up, we may get a reaction from this supply zone, come back down, but then break it. Okay. This is a perfect example of when a supply zone fails. Okay. So this supply zone has failed because the job of the supply zone was to push price down to cause this break of structure. Okay. But again, what happens if we don't get that? And then we push back up and we mitigate this supply zone, meaning we've retested it, we've tapped back in, got on a reaction, but then pushed up again. Back to, did it break structure? Has this demand zone broken structure? Yes or no? Yes, it has. So is this demand zone validated? Yes or no? Yes, it is. So what can we expect from here? To be mitigated and continue to the upside. Okay. So this is actually a perfect example. And one more example that I'll show you, which actually might make the light bulb go off in your head. Listen, we've got bullish market structure going to the upside, okay? Let's say somewhere here to the left, I'm not going to draw it on because we'll be here forever, but let's say somewhere in the left here, we have a supply zone, okay? Price is now bullish because we know with this internal structure, price is now bullish, okay? Oh, what am I doing? Let's draw this on. Okay, so we somewhere in the left here we have a unmitigated supply zone, valid supply zone, but we now know that price is bullish. Okay, so we've got this low, made a swing high, swing low, swing high, and we've mitigated this fresh supply zone all the way from the past. Okay, there was a fresh supply zone here. We've mitigated it. We've mitigated it, but what is the job of a supply? The job of supply is to cause that break of structure, right? Is to cause the job of the supply is to cause a new low. In this sense, did it make a new low? Clearly, no. Clearly, it didn't make a new low. So we have mitigated this supply zone, got a reaction from it, but then broke it, right? We broke it. So in the same sense here, look, we've come down, come up here, we've got supply here, came down, got a reaction, but we didn't break this low. So we've mitigated it, caused the supply zone to fail, then in turn creating a fresh demand zone here because it took demand to step in. It took the buyers to step in with a lot of money to break this structure. So we've caused a fresh demand zone here, came down, mitigated the demand zone, and gone off. So I hope for some of you this is starting to make the light bulb go off in your head. You're like, oh, I get it now. So look, we've got this fresh supply zone here to the left that got mitigated, right? Pulled back down, got a reaction from this supply zone, but then this supply zone has failed because we've broken above. What's here? What do we have here? Demand zone. So it's the same thing here. This is a valid flip zone because we've got supply here that we've tapped into. We've reacted from that supply, came down, but failed. The supply has failed to do its job and break this low. Came up, we've made the supply fail, then causing a demand zone to be created here because it took money, a lot of money to break this high and make this supply fail. Mitigated the demand zone and gone to the upside. Does that make sense, everyone? That is a flip zone that plays out day in and day out. Just for my information, are you drawing this as a daily time frame, right? Yes, correct. Correct. This is always when I'm talking about swing structure, I am always showing you what would happen on the daily time frame. Is this smart money concepts? Yes, everything I'm showing you here is smart money concepts. Okay, is it so far so good for everyone? Perfect. And remember,
one thing I just wanna say is we want to be entering in on supply zones and demand zones that have institutional backing. And what do I mean by institutional backing? When you hear the word institutional, think of money, okay? Think of large amounts of money. So we've got money here that caused not only this high to be broken, but this supply zone in the past to fail. So that took a lot of money. So then once we tap into this demand zone, remember, this whole zone here, there's money here. They want to protect their money. So not only look like, let's forget about demand and supply right now, just market structure. This low, okay, it caused a lot of money to break this high. So we've got a break of structure there. This low now has money there. They want to protect this money, and who I mean by they is the big banks, you know, the Goldman Sachs and BlackRock, all of those big corporations and institutions that have a lot of money, and they put through trillions of dollars or whatever currency through the market every day. They want to protect their money. So what would they then do? They would push price back up to make sure that this zone doesn't fail and all their orders get swept, all the liquidity gets swept and their money just goes to waste. Okay. So I hope that makes sense. Is it possible to trade this strategy on a lower time frame? One thing I will recommend to you, or a statement rather, the lower of a time frame you trade on, the much more harder things become. Why? The reason it is so is because on a lower time frame, you have so much noise. On a lower time frame, you're gonna have a breaker structure here, a change of character here, another change of character, breaker structures, and it's just so much mess. That's why I say to you to always start on the daily time frame so you have that clear direction of the market. So you can see what I like to call the skeleton. Okay. So you can even think of it of a human body. Okay. We've got our skeletal structure, which is basically holding up everything. Okay. So we've got the skeleton. But then everything inside, the vital organs, that we've got the brain within we've got the brain within the bone of our skull, okay, the skeleton of our skull. We've got the lungs, the heart, everything, the spleen, the everything inside, the vital organs. That is, we could even liken that to the internal structure within the lower time frames. Okay. But if you had just vital organs there alone, so if you was to have, I know this isn't the best example, but in a bowl, let's say you've got a bowl and you've got a heart, a brain, lungs, spleen, liver, kidney, all in there. Does that show a living person? Is that a human? No, it's not going to work. It needs to be within the skeletal structure, housed inside the skin. And not the best example, but I hope you guys can understand what I'm trying to get at when I explain this. So the daily time frame is your skeleton. So it's that clear direction of where price wants to go, the objective of price. Then you can go down to your median time frame, which for me is the 4 hour, where you can then find your POIs. And then you go down to your lower time frame, which is the 15-minute, and refine those POIs. It's not to say that this doesn't work on the smaller time frames. Of course it does, because the market is fractal. Everything on every single time frame, whether it's the monthly, the weekly, the daily, the 4 hour, 3 hour, 2 hour, 1 hour, the 10-minute, the 50-minute, the 5-minute, the 30-second, the 1 second, it doesn't matter. It all is so closely related. Everything is so closely related in what it's doing. Okay, because it's price action. The markets are fractal. Okay, but what I recommend is that you first start on trading on the daily time frame as your higher time frame, the 4 hour as your medium time frame, and the 15-minute as your lower time frame, because it's much more easier to learn what I'm teaching you on those time frames. Once you have everything down to a T, once you really understand everything on those time frames, and you're profitable, out of 10 trades,
8 of them are correct, let's say, and you are really doing well within those time frames, then you can start to think about making the 4 hour your higher time frame, then the 15 minute your medium time frame, and the 1 minute your lower time frame. Because I'm not gonna lie to you, the 1 minute time frame, if you are able to understand what's happening on your higher time frame, which is the 4 hour, scale down to the 15 minute to refine the POIs, but then go down to the 1 minute to time your entry, your risk to rewards are going to be absolutely crazy. I've seen people that trade on the 1 minute time frame and they have risk to rewards of 1 to 46, 1 to 60. Imagine going in a trade risking 1% and you make 60%. But all of that comes with time. So I really recommend that you start with the daily as your higher time frame, the 4 hour as your middle, and the 15 minute as your lower time frame. And once you really master everything, then start to think going down as the 4 hour as your high, your 15 minute as your medium, and your 1 minute as your low time frame. Okay. I hope that makes sense for everyone. Does everyone understand that so far? And I think that concludes supply and demand for the theory of things. Are you guys happy to go into the live charts and really so I can show you these things play out? Yeah, cool. So let's delete all of this. Let's go to Euro USD because it's moving very nice recently. Okay, cool. So remember what I said to you. Daily time frame is the higher time frame. 4 hour is the medium time frame, and the 15 minute is the lower time frame. Okay. So we are now currently on the daily time frame on Euro USD. We want to know with the daily time frame the objective of what price is doing. Okay. So look at this. In the past, we had a change of character to the downside, showing what that price wants to go bearish, correct? So we've came down. Okay. This is the low. Pulled back. We've had a considerable, can you move your watch list, please? Yes. Apologies for that. So yes, change of character to the downside. So we have a bearish change of character, showing that price now wants to go bearish. We have now pulled back, considerable amount of pullback. I wouldn't class this as a very nice pullback just because of like comparing it to previous price action. It's not that large. So we've pulled back here, made a new high, okay, and then even scaling down. You know what? We'll go into that in a minute. But just looking at this from swing structure, okay, we've got this high that caused that change of character. So we know. So now we know price is bearish, right? Look at this. We've pulled back up. So now this is our new low, our weak low, made a new high. Okay, we're going to go into how we can anticipate that price is now ready to make that swing pullback. But first, let's just look at swing structure as a whole. So low, weak low, strong high, and then this is the highest point that caused that break of structure. Okay, so the bearish momentum has really stuck to itself here. Now look at this. Price has made that low. Okay, and what can we see here? Price has pulled up. Has it pulled into the 50% mark? Yes, it has. We can see that we've pulled into the discount of this whole leg, okay, or the premium rather, because we're selling. So we've pulled into the premium, so now we know it's a good place to essentially look for sells. But even deeper than that, look what we have here. Anwar has said, I need to know how can I out of time, trading time, shade flips down or up if I enter with 4 hours, is it considered day trade or swing trade? I need I need to know how can I.
So if you enter with the daily, if you enter with the 4 hour time frame, considering like it's quite a high time frame, and if you want to get like a 1 to 3 risk to reward, that would be considered a swing trade just because of the fact that it's the 4 hour time frame, and you can see these candles on the 4 hour time frame. Like let's say let's say you wanted to enter here because you saw prices now going up. Okay, even though I wouldn't recommend it because we've already tapped into the discount, but just for the example, let's say we did. So we have this demand zone here. So let's say we entered on the edge of the demand zone, which I don't really recommend doing, but we've gone through already how to refine the zone. But just for time's sake, let's say we enter in here and we have this trade for our 1 to 2. It isn't until here we hit this trade. And how long did this trade take to play out? So we tapped in here and it finishes here. That's a 43-day trade. I think that classes as swing trading, you know? So if you're entering on the 4 hour, then yeah, you're considered a swing trader. That's why me personally, I could never trade like that. I'm going to be very honest with you. My patience is not the best. I don't have the best patience. I've got just enough patience, but not enough to wait 43 days for a trade. That's why my lower time frame is the 15 minute. And you see all of these daily moves to the upside. You you could look at these you could look at this. You see this nice candle here? I'm just gonna move that. You see this nice candle here? That could very easily be a nice 1 to 5 risk to reward on the 15-minute time frame that only took a few hours to hit. And you would have had much more risk to reward than actually aiming for this. Because remember, you've entered in on the edge of that demand, and you've only got a 1 to 2.4. Sorry, a 1 to 1.24. So you've risked 1% and you've made 1.24%. Like that's not really that good compared to maybe getting in on the bottom of this leg, maybe having your stop loss down here somewhere and then aiming for this high or whatever. Like or let's say you aim for here. This is just theoretical, okay? That trade would have maybe took a few hours. Apologies, but you've got a 1 to 3.45 trade. So you can see like the difference between being a day trader and the difference between being a swing trader. Okay. This is basically what I do. I go down to the lower time frames to then get my risk to reward increased much more. And also so I'm not in a trade for hours at a time. Okay. Or days at a time rather. I personally, for me, I have just enough patience to get in on a trade in London session and then get out just before the market closes on New York session. I have that patience to stay in a trade for 10 hours. I don't mind. But it's when it's days and days and days at a time, I'm just not that type of trader. Trading on the higher time frame is for people who have huge amount of money on their account. Yes, that's true. That's true because you like let's say somebody who has I don't know like let's just use these banks as an example. These banks have got billions with a B, billions to trade with, you know, and they could be putting in 10,000 lots. Even the same example that I said to you with the company America who wants to transact their money for euros. They've given the banks 10,000 lots to trade with. 10,000 lots is a lot, you know? We don't trade 10,000 anywhere near 10,000 lots, you know? Like it's a lot of money. And those trades that they take, so let's say they entered in here on this demand zone here, right? And they have a fixed risk to reward of like 1 to 10 or something, you know, that's a lot of money. With 10,000 lots, I can't even begin to fathom how much money that would be on a 1 to 10 risk to reward with 10,000 lots. Like that's a lot of money, you know, like that could feed all of us here for for 50 years, you know, like that's a lot of money. Anyway, exactly, it is a load of money. As a scalper, what time frame you recommend to play with? Okay, so I used to be a scalper for all of you who don't know. I used to scalp and I would use the 15-minute time frame as my higher time frame. I would use the 5 minute as my medium time frame and my 1 minute as my lower time frame.
Some of you guys may think that's crazy, but it worked. It worked. But yeah, so definitely within the 1 minute to 15 minute time frame, I would recommend that for scalping because you're getting in and you're maybe securing 5 pips and you get out, So yeah, definitely 15 minute, 5 minute, or the 1 minute. It works. Amazing teacher, thank you. Thank you. Your kind words mean a lot, honestly. Thank you guys for being here, honestly, and listening to my boring voice. Abdullah Rahim, it works. Yes, it works. Scalping works for sure. But again, scalping is more so for those people who I mean not to say not okay, because I know there's some traders out there that have hundreds of thousands and they scalp. But scalping is more for when you have maybe a $50, $100, $500 account and you want to quickly flip it to like a $2,000 account. And then once you have that type of capital, like $2,000 in account, then maybe start to think to stop scalping and take these high probability trades, because scalping can go against your favor very, very quickly. I think we all know that. I think when we all started to trade, scalping seemed like, the holy grail of trading because we could make a lot of money very quickly. But I think you very quickly understand that it takes a lot of knowledge to scalp, and the trade can go against you very, very quickly, because people who tend to scalp tend to not have a stop loss, so you're in the trade thinking, oh, it's going against me momentarily, and you get out when you've lost 50% of your account, when you could have just put a stop loss at 1% and lost 1%. But anyway, we all know this. But let's go back into this for now. So daily time frame, we can see that we are bearish, obviously, and we see that we have made a new low here. Okay, so we have pulled back up to cause price to trade within the premium of this pair. Ibn Aziz said, can you please analyze this pair and show us your confluence and bias? Yes, I'm going to show you everything exactly how I would look at this pair and trade it. In fact, this is the trade that I took on Euro USD on Monday. I'm going to show you the exact thought process that went through my brain when I took this trade, okay? So look at this. We'll go through it from the start again. Daily time frame, we can see we had a high here, break of structure here. So at this point we was bullish, but then this high caused a change of character, breaking this low. So we know now that we are bearish, correct? We made this low, pulled back up for a high, and we are continuing to the downside to break this low, causing a break of structure. Now we have this low and we're pulling back up, and we can see that we are within the premium of this range. So we now know that it's highly likely that we should look for sells, correct? And look what happens. After we trade within the premium of this price range, look what happens here. Internal structure wise. Low, high, low, high, low, high, lower low. So what does that indicate? That indicates that price now wants to flip bearish. And let's even overlay fractal structure into this. I'm using the daily right now, Big Dreamer. I'm using the daily. This is all for showing the direction of price, okay? So look, we had that internal change of character, but let's not even worry about that right now. Let's look at fractal structure. So all of this are continuations to the upside, okay? Then we get a fractal pullback here. And I appreciate this might be quite confusing for some of the newer people, but please go back and watch the Three Musketeers of Structure. It's a YouTube video that I have posted there. The link is in the Discord, and you will be able to understand fractal structure after watching it a few times. We have this candle here. So after this high, this candle fails to break above it, right? So that's a fractal high. So now we need to look for our fractal low. How do we do that? We look for the previous candle or the nearest candle to fail to break the previous candle's high. So all of these candles break the highs until we get to this candle here. So this black candle fails to break the high of this white candle. So this becomes the fractal low.
And once we have that fractal change of character, which we can see we wicked below and then finally closed below it, what does that indicate? That indicates that we are now getting an internal pullback, which we actually do get an internal pullback into the discount of this low. But then what happens? We get an internal break of structure or an internal change of character. Now, I want you guys to write this down. When we have a fractal change of character, which indicates a internal pullback, paired with an internal break of structure or an internal change of character, whatever name you want to call it, that is what indicates that we are now having that swing leg to continue the movement. Okay. And what I mean by that is, look, bearish, we're bearish, right? High, low, high. We've got that fractal change of character and internal change of character. So now we know we're coming back to complete this low to be broken to to show that we are now continuing bearish, right? But let's overlay multi-time frame analysis into this also, because okay, fine, we've got this fractal change of character, we've got this internal change of character, so now we know price really wants to flip bearish. But what happens after an internal low breaks? We need to wait for what? The 50% mark of this leg to be broken. So let me just draw this on fresh for you guys to really understand it. Low, high, lower low. So we've broken this low, showing that price wants to flip bearish. And remember what I showed you guys. If price breaks this, what do we have here? Can anyone tell me? What do we have here? Because remember, it took a lot of money to break this low. So what do we have here? Supply zone. Perfect. So what do we look for? We look for that mitigation to then continue to the downside. The same way here. We have supply within this level, okay? All of this is valid supply because look, it took a lot of money to cause this break of structure or this change of character rather, sorry. So what do? We want to trade within that premium pricing where price is now cheap for us, okay, to sell from, or it's a better price to sell from. Not cheap, sorry. So now we could potentially look for longs, until we get into this discount. The closer we get, sorry, I keep saying discount. The closer we get to this premium price, the less higher probability these buys are gonna become, okay? Because we're into that premium now, and price could then drop off. But remember, the same way I just showed you there, we break this low for a change of character, so that means there's supply within this range here. We tap the supply and we go down. That's the same thing we're looking for here. Look, we've got this push up, push down, push up. Same here, push down. And we break that low the same way we break that low. So what are we looking for? We're looking for price to come up into the premium of this before coming down. And that's why I scaled down to the 4-hour to then see the bigger picture of things, or sorry, not the bigger picture of things, that's for the daily, but to find our POIs. So look, POI right here, we've got this low, high, low, high, low, and we're pulling into this low, okay? That's why I then saw that we had mitigated on the 4-hour, so I went to the 15-minute and I saw that we had mitigated a fresh demand zone on the 15-minute, and this is the trade we took on Monday, where we hit final take profit. We aimed for up here, and our stop loss was somewhere down here for a 2.6 something. And that's that trade. That's how that trade played out. So you can see now how we used the daily time frame to understand the objective of what price wants to do on the higher time frame. Okay, so we understood the objective that now we had caused an internal change of character. Okay, so we now know the objective that what price wants to do now is to come up into the premium. So we now know that we could potentially look for longs. So we go down to the 4-hour, okay, which is what one guy says the soldier for the daily time frame, okay, because the 4-hour basically shows intently what's happening on those POIs, or rather makes those POIs much clearer to us. And you can see here it does.
So we get that low, high, low, high, low. Okay, we've tapped into the demand range of this whole area. You can see we've ranged before getting that initiation. So remember that example that I showed you, we have a range before that initiation. Okay, so range, initiation. What's this? Because remember, we have the initiation phase. What phase came next? If you guys have been listening, what phase came next? Mitigation phase. Perfect. So we had that mitigation phase. Now what phase are we looking for next? Timo, I'm expecting you to answer this now. What phase came next? We had the initiation, mitigation, and then there's one more. Nobody? Okay. We had the continuation phase. Okay, so we've continued after that mitigation. Okay. So that's what we was essentially looking for here. Okay, so we'll start again from the top. Daily time frame. We can see internal structure flipped bearish. Okay, so now we want to wait for price to come into the premium. So now we can see that we could potentially look for some longs. So we get down into the 4 minute, 4 hour to potentially look for some nice POIs. Low, high, low, high, low. We've pulled into this POI, this whole demand range here. But again, we don't want to enter on the edge of this demand range. Why? Because we will have a terrible risk to reward. So we went down to the 15-minute time frame and we saw that price tapped into this demand range. Very, very clean demand range. There was no mitigation, no no wick tapped into it. It was a very clean, unmitigated, fresh demand zone. We've pulled away from it, showing that there is money here. Not only that, we caused this break here, so we can validate it. And now look, mitigation, continuation. Does that make sense? Perfect. Right. So that was an example of essentially what I do when I look for trades. So we start from the top. We look for the higher time frame objective on the daily. We go down to the 4 hour to look for POIs, and then we go down to the 15-minute to refine those POIs to get a higher risk to reward. And that is the simplified trade plan of essentially how I trade. That is a very simplified version. Of course, there's a lot more in-depth matters of this and this and this. We won't go into that now. That's for the putting it all together live stream, where once we complete we've completed market structure, we've completed the three musketeers of structure, and we are completing supply and demand today. We still need to go through liquidity, entries, and after we have completed all of that, we will then do a finale live stream where we put everything together. Okay. And once that's done, you guys will be able to add to this simplified trade plan to make it an elite trade plan. Okay. So from now on, EU, what would you be waiting for? Okay, guys, I'm going to answer that question, but I've got less than a minute left in this live stream. So I'm going to send a new link and we will answer that question. Okay. See you guys in a second. I'll send the new link. Okay, so we are going to start in a second. We'll just wait for a majority of the people to join back. And we will look for what we're looking on Euro USD now. Is the person here who asked that to see what I'm going to be looking for now on Euro USD? Are you here? Perfect. Cool. So Euro USD now. So what do we see on the daily time frame? We can see on a daily time frame that we are still within the discount of this price, but we need to head back up to the premium, right? To continue that movement to the downside. So what do we see? We see that we are still within this demand zone here, right? We see that we're still within, and we can see that we pulled down to the very uh end of the box of that demand zone. And sorry, I just had a message. Who was that? Oh, yeah, same person. Cool. So yeah, we can see that we're at the edge of that demand zone, and we are now showing some retracement to the upside. Okay, so that would show me that we are now possibly heading to the upside, because you can see here, internal structure wise, low, high, and we're making that low. Okay, we tried to make a new high, but we didn't close above, so we are still within this low. Okay, and this is currently the protected low. So until we break this low, we're not looking for any more sales, okay? Until we come up close to the discount. Remember, we don't have to come up into the premium, so we don't have to come up into the premium. It could come like around this area even before heading back to the downside. But we'll get into that in the entries module, which is going to be a bit later on in another live stream. So yeah, daily time frame, we can see that we are currently bullish, internal structures bullish. We're heading up here to the premium to then look for sales. But again, we're still looking for those buys. So it goes to the 4 hour, okay? So the 4 hour, again, same thing. Internal change of character, fractal change of character, low, high, low, high, low. And we're still within this whole low range, okay? And look, we could even see a yeah, you know what, we'll get into that a bit later. I don't want to confuse you guys too much. On 4 hour, is there a POI at the most extreme demand? Yes, and this is what I'm going to get into with you guys. So we have this extreme demand here. And what do we see here? Although we're not talking about liquidity, well, I've just given you guys the answer now. What do we see here? Liquidity. And what did we talk about before? Liquidity could be an area of inducement. So we could see price head down here, break this liquidity, or rather sweep this liquidity, tap the most extreme demand before heading to the upside. Okay, so look, this could be a very high probable trade. Not even could be, it is a high probable trade because this is the most extreme demand. So let's say we put our trade here and we have our stop below the protected low, which we'll chat. One more POI on the 4 hour down. Yeah, but this is below this low. Remember, we expect this low to hold. So we don't expect this POI to be met because of the fact that the internal structure is bullish. Okay. So we have this low, this high, this low, this high, and we're now within this low. Okay. So this is the most extreme low, and this is below this protected low. So we don't expect this to break. Yeah. Perfect. So yes, so we could look for something like this, and we could put our stops below here, below the protected low, just to be safe, and our high here. And I've even got this marked on way before we even talked about this. This is now our week high. Why is it a week high? Because it failed. It is currently failing to break this low. Okay. So again, extreme demand. We've pulled down, and we could tap into this before heading to the upside. Okay, but this is where we use the 15-minute time frame to refine our entries. Okay, so as you can see here, this is the box where that demand zone is. So let's zoom within here. We could refine it to this. And even though it is mitigated, remember it's mitigated, so that would be quote unquote a low probable area for it to pull back into. Just because it is mitigated, what's this here? Sorry, not that one. That's mitigated. Because this candle, the next candle closes above. So you could even arguably say that this, even though this is a bullish candle, arguably it is a valid demand because of the fact that the next candle closes above, and then we get that true demand stepped in to break all of this structure here. Okay. So if we pulled this to the right. And this is live. This is a trade that actually hasn't happened yet. So not only have you guys had a live stream, you've got a probable trade that you could actually get into very possibly soon. So let's just pull this to the right. Okay. So this is where the 50-minute comes in so handy because look, instead of getting in here, so let's just go to the 4 hour again. So now we know that this is our refined 15-minute zones. This is a bit messy. Apologies, guys. 1 second. Let's just clean this up a bit. Right. So we know that these two zones here are our refined zones. Okay, they're within the discount and they are valid because they both caused they're both where that real demand stepped in. Okay, so we could come back down rather than entering on this edge where we get a 1 to 6.65, even though this is a very nice trade, even if you was to enter in here, which you may want to do, you may want to cut out all of this extra work or extra nonsense or extra noise, whatever you want to call it, and just enter here. And you could be happy with the fact that, okay, we might go into drawdown for a bit before going up. But if you really, really want to improve your risk to reward and you really want to get in with a better risk to reward, you could enter in on this zone where you get a 1 to 9.5. Risking 1% on this trade would pass your phase one. Okay. And look at this. If you was to even enter on the most extreme, like, bro, enough said, this is like on a live, let's say on a real live 100K account, let's say you've passed this is all hypothetical, but I'm saying just to give you guys motivation on to really, really study this strategy. If you was to get in on this trade on a live 100K account, as in, you're able to take payouts and whatnot, and you took this trade with a 1% risk, this is a lot of money. This is 14,000 euro dollars, 14,000 on one trade, you know? And again, this trade could take days. This trade could take days, but $14,000 is essentially half of someone's yearly salary, which you made in maybe a month or two just by waiting out this trade. So again, patience, patience, patience. But if you really wanted to just get in on those trades that are like, quick few hours, you could just follow this up, daily time frame. You could see price coming up, making some pullbacks, getting on those POIs to get higher. Sorry, I sorry, I don't hear. Are you waiting for in that POI or trade right away? Would you recommend to wait for lower time frame confirmations? Yes. So it's essentially what I'm saying now is that we are still within so on the 4 hour, we have this whole demand range. So if you wanted to, it could be a very nice trade. You could enter here. Okay, guys? The coordinates are here for you. If you really want to write this down and maybe even set a buy limit, the orders are there for you. Like, I'm going to be very honest with you guys. This would be a trade I would take. So if you really want to, go ahead and set your buy limits right now. I'll leave this trade up there for you to take this trade. This is a high possibility trade. It really is. Because again, we've got the most extreme demand, which has inducement above it. So this is a very high probable trade. So if you want, guys, I'll leave this here. Take profit is there. Stop loss is there. Entry point is there. Okay. This is a very high probable trade, guys. So if you want to, as I said, you can go ahead and set a buy limit or just jot this down in your notes to look at later. But yeah, this is a very high probable trade. But again, as I said to you, if you really want to refine your POIs to get a much higher risk to reward, what do? You go down to the 50-minute time frame and you look for those refined POIs within this leg. Go back to your 4 hour. Now you have those legs, you have those refined POIs drawn out. And all you do is move your entry. down to there. So if you was to enter at this one, you have a 9.5 risk to reward. So that's risking 1% on this trade will pass your phase one. Or you can enter down here with a 15 risk to reward. But again, if price was to come down, so just imagine this POI is here. So we've got the main POI, we've got that first POI within that POI, and then the most extreme refined POI, okay? So I missed earlier part. After I find down the POI to 50-minute, we have 2 refined POIs. How do we narrow down to which POI to enter? I apologize if I asked a silly question. No, no question is silly. It's a very valid question because listen, you could have your POI here. You could be so dead set on only entering on this extreme POI, and you've done nothing wrong in wanting to do so. But listen, if price comes down and taps into this POI, right? And then we get something like this, you should be ready to accept that this zone hasn't been hit. But with in the back of your head, you know that the whole range is valid demand. Forget about the refined zones for now. This whole range is valid demand, okay? Which you've tapped into. So now you have to sort of bite your tongue and say, okay, we haven't hit my refined POI, which I would like to hit for a 1 to 15 risk to reward. But I can see now that we've came down, internal structure is bearish, we've tapped into the overall demand. We've got that change of character. I'm ready to enter in on that fresh demand to then enter higher. So that is how you then what was the question you said? Yeah, that's how you narrow down basically which one you would enter in on. And even on the other sense of it, if you saw that internal structure was staying bearish, what can you then think? Okay, yeah, we may be entering on this extreme demand range, demand zone rather, sorry. But then you have to be careful because listen, all of the internal structure is bearish. We're not showing any signs of bullishness. So you may want to wait for price to show that bullish structure shift before getting in on that demand to go back up. Okay, so it's all about stacking the odds on your side. Yes, Gideon, the recording will be shared. I just had to double check if we are recording, and we are. We've been through 2 other live streams today. This is the 3rd one so far, including the other 3 that we did about a month ago. So we are now actually finalizing supply and demand, and we will be uploading this on YouTube within the next day or so. So you guys can definitely go ahead and do further studying on this. Carl says, thank you for that explanation. No problem at all. So is that good for everyone? Do you guys understand that so far? No problem, Justin. I'm going to draw this one back on actually, just because it is valid. I will look to enter this one if we do get down there. I'm going to set my limits as well. There we go. Gideon says, thanks, you are doing a great job. Thank you for your kind words. Thank you guys, honestly, for being here. It really does mean a lot to me. Thank you guys. So yes, we have covered the premium discount pricing. We have covered how to refine a POI. It's the same if you was to refine it on a supply, same as demand. It's the same exact process you go to refine. What else have we gone through? We've gone through flip zones. We've gone through yeah, we've pretty much gone through everything within the supply and demand module that I wanted to go through. What haven't we gone through on the live charts though? Because we've gone through everything on the theoretical, but we haven't gone through everything on the live charts. What haven't we gone through on the live charts? Flip zones, I believe, right? I think flip zones is the last one. Am I missing out anything? And Melvin says, so the 50-minute break of structure is actually your confirmation of where price will be heading to, whether bullish or bearish, right? Not necessarily, because the daily time frame has already showed me that we're going bullish. You know, the daily time frame has already showed me that we need to come up here. Well, not need to, but it's a higher probability that we will come up into this premium before dumping. The 15-minute time frame is essentially just to help time when I should get in that trade. It's just for the execution. 15-minute time frame is just for execution. It's just showing me when is a good time to get in, because it's all good to say to get in here for this long, aim for that high, uh, stop loss just below the protected low. Like, okay, this could be a good trade, you know, but what, like, price could come in and have drawdown. So that's what I'm saying. Like, it might be better for you to then let's that's a big long tool. It could be better for you to essentially time your trade. So as I said in that previous example, if we come down, so let's say this is price now, right here, we come down and we tap into the POI, we are in drawdown right now. Okay, we're in drawdown. We would be seeing red numbers. We would be in minus. Then we could see all of this and then have that change of character and then get that push. Why would you happily? I mean, I'm saying it like you shouldn't do it, but it doesn't really matter. All I'm saying is rather than entering up here, you could have entered down here on this refined POI and got a much higher risk to reward and would have got a lot more money for doing your analysis. Does that make sense? So it's not that the 15-minute is essentially showing me whether I'm going bullish or not. No, the daily and the 4 hour have already confirmed that. It's the 15-minute that is just timing the execution. That's all it is. So if you guys want to write that down, the daily time frame is just showing me the objective of price. It's showing me where price is going, the direction. The 4 hour is for those POIs, so I can draw my POIs in the 4 hour. Then the 15-minute is for execution, for timing that trade to make sure you get the most risk to reward possible for doing your analysis. Okay? Because you want to get paid. You want to get paid. Timing your execution, perfectly explained. Thank you, sir. No problem. So yes, apart from flip zones, is there anything else that I have missed out to actually show you on the live charts? So apart from flip zones, is there anything else that I need to show you on the live charts? Justin said, will price break 15-minute POI after refinement? I think if price breaks 15-minute, but it means it didn't get the right POI in 50. Yeah, so essentially, if price, so remember, we had these refined POIs somewhere within here. Just to save time, I'm not going to get the exact ones, but if price comes down, remember, this is our overall, this darker box here from here to here, this is our overall 4 hour demand, okay? These two smaller demands are just the refined ones. If we come down and we break this demand, yeah, like that was the wrong POI. We can just delete it. Now we know that we have this extreme one that needs to be mitigated if price is going to continue bullish. Remember, that's the key word. If price is going to continue bullish. That's why when you're at an extreme demand, I really recommend you look for this entry model, you know, to make sure that you can see internal structure being bearish, but then it flips bullish and then enter in on this demand to then, you know, get that longer term trade for the buy. I hope that answers your question, Justin. Right, so no one has answered if we're missing out anything apart from flip zones. So we will cover flip zones now on the live charts, and I think we will leave it there until we have our next live stream, which I believe is liquidity, which is the next live stream we'll be doing. Melvin said for this section it's only flip zones, so perfect. So we will cover flip zones and then we will leave it there and come back another day, maybe next week sometime, and cover liquidity. Okay, hope that's okay for you guys. Right, flip zones, flip zones, flip zones, flip zones. So look at this. What can we see here? We have a downtrend, right? High, high, low, high, low, high, low, high. Okay. So we've come. Oh wait, apologies. No, I was looking at the wrong. I was looking at the wrong area. Sorry. High, low, high, low, high, low, and then we've got um this high here. We've come and we have this whole supply range here. Okay. So again, we'll go through that one more time. High, low, high, low, high, low. And then we've got this high here. So sorry, my mind is all over the place. Sorry, guys. Yes, this was the correct area. So we'll just go through that one more time. Apologies, guys. I'm all over the place right now. High, low, high, low, high, low. And then we've got this high right here. Okay. Look at what that high did. So we've got this supply zone here where price reacted from. Okay. So we had that reaction. What is the job of this supply zone? Just so I know you guys are listening. What is the job of this supply zone? After hitting this supply zone, what should price do? To break the low. Perfect. We should get a reaction from this high, from this supply, and break this low. But we don't. Justin said make a lower low. Perfect. We mitigate this supply, get a reaction, and this is the key. We have to have some type of reaction before the zone fails. That is a valid flip zone. If you don't get a reaction and it just goes through, that's not a flip zone. That's a structure zone. That's just a change of character, essentially. So we have this high with the supply zone in it. We've pulled back up into this supply, respected it, and respected this strong high as well. Got a reaction, but then look, we cause it to fail. What does that leave here? Because remember, it takes a lot of money to cause a break of structure or a change of character. So what do we have here? A demand zone. Perfect. And you could have entered in right here on the edge of the demand zone, stop loss below the strong low, aim for the weak high, and that would have been a nice trade to enter in on. That would have been a 1 to 3. It would have took, how long would that trade have taken? Because we're on the 15-minute. So that would have taken about 1.5 trading days. Sorry, 1.5 trading weeks. Sorry. So the 5 days, then about half a trading week as well. So although that is essentially a swing trade, like this is a good trade. This is a very good trade. And you could even further refine this. This is what I'm trying to say to you about refinements and going down to lower time frames. What do we see here? High, low, high, low, high, low, high. I'm zooming so you can see it. What do we then get here? We get that bullish change of character entry model. Okay. So then price then retraces a little bit. We don't get that mitigation into this demand, but it does come down into this sell to buy wick. So you can see we've got this sell on a lower time frame on the 5 minute and 1 minute. This would have been a sell before we got that buy. And we're gonna cover this in future live streams, what I mean by this. But look, we've got that sell candle. So again, on the lower time frame, this would have been a sell before we got that buy. So this is a valid zone that you could have entered in on, you know. Refined your zone. So enter in on the edge of that box there with your stop loss maybe at the low. And you could have aimed for this high just to keep it short and sweet. And you would have had a 1-to-3 risk to reward ratio by following the exact mechanisms that I'm showing you to get in on good trades. And you would have got a 1-to-3 within about 19 hours. So a day, and that is a trade that I wouldn't mind staying in. As long as I can see that this internal structure is staying bullish and I shouldn't have any worries about, bringing my stop loss to break even just to be safe, that I would stay in this trade. So this is where you can see flip zones, they play out. So I hope that was a good example for you guys. Do you understand, or should I go through that one more time? Very good example. Perfect. Everyone else, I really don't mind to go through it one more time before we end here. How do you draw the 50-minute POI after breaking the supply zone? How do you draw okay, so you're talking about when we actually get that flip, aren't you? So like when we break this supply zone, right? Yeah, cool. So the key thing to having in the back the key thing to have in the back of your head to actually get a successful trade here is that the low of this is where the money came in. It took that money to really push up to get that flip. Okay, because remember, first we came down, caused that breaker structure here, so we know there's supply here, money from the sellers are here. We come up, get that reaction, and we again we react from that zone. But then what is the job of this supply zone? The job of this supply zone is to then push price further to break this low, but it doesn't happen. We get this pull back straight back up into the supply zone and we cause it to fail. So then we know that the demand money is at the low here. Okay, we know it's here at the low. And then look, that's where you would draw your demand range here. Okay, or maybe even refine it or whatever you want to do and get in on this type of trade. Okay. Or even as I said before, to then not be waiting what was this, like a trading day and a half until we reach that final TP here. You could have entered in, zoomed in here. You could see that the internal structure flipped bullish and we entered this sell to buy wick. So that would be your valid zone. Enter in on the edge of that wick and aim for this high to keep your take profit short. You get almost a 1-to-3 there, and I think that took about 18 hours, didn't it? So yeah, that's essentially how you draw your 15-minute POI after we break this whole supply zone and cause it to fail, because then we've got that supply that kicked in, we've reacted, got that flip. So now where's the demand zone? Here at the low. We mitigate that demand zone and then we go to the upside. I hope that answers your question. I think I have to understand better how to identify the valid POI in the earlier part. Yeah. So again, as I said, this will be uploaded onto YouTube. I'll be doing the piecing everything together as soon as we finish this, and it will be uploaded to YouTube, and I'll send the link within the Discord so all of you guys can watch that video over and over again, study it and get it down to a T so you really understand, okay? No problem. I think that concludes supply and demand then, guys. Very, very, very nice stream, including what we spoke about before. I think it was about 3 live streams that we took a month ago where we started supply and demand, and we've only finished it now. But yeah, so you're actually going to have a lot of stuff to go through. So yeah, it's going to be really, really valuable for you guys. So I will let you know as soon as I've uploaded the video onto YouTube, and I'll send that link into the Discord. Okay, guys? All right. Well, again, thank you guys for joining, and I will see you next week for the liquidity live stream. Okay? No worries, Carl. Thank you all for joining. I will see you guys soon.
First time joining for me. Very informative and insightful. Great job, sir. No problem. Thank you for joining. Thank you, Melvin. Thank you, everyone. I'll see you guys soon. You do any more signals this week? Yeah. So if we see this Euro USD trade play out, where we tap into this demand zone here, yeah, definitely I'll be getting in long here because it's a very, very high probable setup with this inducement paired with everything else. Definitely a good trade to get into. Even if it's not Euro USD, it will be another pair. Ah, yes, Melvin. Very, very good thing to point out. We have we have FOMC tonight. So try not to trade. Just me being very honest. We have FOMC, so try not to trade. We may even break straight through the supply. But let's see. Let's see. It might not even be such a severe reaction, but we'll see because it's Euro USD. Even though it's a dollar pair, we may get a slight reaction. But yeah, we'll see. Anyway, guys, thank you for joining. Have a good rest of your day and a good rest of your trading week. I'll see you next week for the liquidity live stream. Peace.